Hi guys, good afternoon. Can I confirm my audibility? Please confirm my audibility. Azmat, I don't see you physically today. Right, so I actually moved today's class an hour ahead because there is a lot that we have to cover today. And had we not moved it, we could have not been able to cover. So what I'm planning to do today is we'll actually be breaking down today's session into two segments, right? So one is going to be before the break, one is going to be after the break. So today expect to receive break a little late as well. So what we are going to do is we are going to discuss three past paper questions. So it's three different past papers where I have selected some important questions that cover the important elements of a single past paper, right? So we have March, June 23, question one from there, September, December 22, the question two there, and then March, June 21, question one from there. So these are three questions that we are going to discuss. So that's going to be before the break, right? And I mean, we intend to spend around 45 minutes a question, 1 hour max, so 3 hours there. Then we will have maybe a 15 minutes break. Then we'll be going on for another 45 minutes. And in that 45 minutes, what I will be doing is I'll be discussing section A questions that is different, that the many students have found challenging. So I have actually gathered most of those challenging questions together, and I want to make sure that we discuss that before you all proceed into the exam, right? So today will be the one before the last TRJ session that we are going to have. The last one we may have most probably on the 1st of December or 30th of November, which I will keep you all informed. All right. All right, Azmat. Okay. So you are going to remain online, is it? Yeah, the reason I wanted to make it, I mean, if you are going to get here physically also, maybe, you can be watching whatever the initial parts are online or on YouTube. But anyway, if you are feeling better online, if you feel like online is effective, totally all right. Yeah. Okay. Right. So we will be starting shortly. We'll be starting in 5 minutes. I'll be right back. All right, shall we start? Right. So, guys on YouTube, shall we start? Just give me a moment. Yeah, so guys on YouTube, you all can be interactive as well. I am keeping an eye on you all as well. So don't feel isolated. All right. Okay, so how's the preparation going? Yeah, everything is from CEB practice platform. These are all past papers. Please, as I told you last a week, please open it on the CEB practice platform and do it with me. All right. So how's the preparation going? 1.5 week left for FR. Yeah. I mean, y'all are just getting into the, the anxiety phase of the examination preparation, I'm assuming, because this is the moment where most of us get those anxiety attacks day in and day out. But as far as y'all are following the proper plan, the 30-day plan that I gave y'all, any amendments y'all made to that or any other plans that y'all are using, as far as y'all stick to it, as far as y'all are covering the 100% content, that is what is important. All right. So what is key? Not perfection, but coverage, right? So 100% coverage is very, very important. So make sure you all cover 100% of the content as well as do as many past papers as possible from your side. Okay, because I have been selecting, I've been doing selective questions, a question that I feel is going to add value, help you all see FR from a different perspective, something that you all would have not expected, so that you all are ready for any surprises in the exams. But what you all need to do is to attempt at least last 8 past papers, and once you'll finish attempting the past paper, read the examiner report, right? That's something I have already told you. And by 27, by mid of the coming week, from tomorrow, the mid of it, maybe around Tuesday or Wednesday, I want you all to attempt the pre-mock. Okay. So why do I want you all to attempt it at this moment and not at the last moment, one day before the exam? Is so that even if you score a little below expectation, you will not have to worry. Rather, you will be able to figure out, okay, what are the areas you need to focus on and focus on the rest of the days. So please make sure that you all attempt the pre-mock in the mid of the coming week, Monday, Tuesday, or Wednesday. Don't go beyond Wednesday. Attempt it, then try to understand the answers, and then we will be discussing that, exclusive discussion of pre-mock in the next session. All right. So next session is purely going to be that, and a little bit of exam tips and techniques is what we are going to look at. Now today, I have selected, as I told you, from 3 different past papers. So you all will have to open, assign 3 of those past papers. And as we are doing it, you all need to be prepared to go through it and do it from your side. So we are going to discuss it today. Complete the past paper from your end. Okay, so it's March, June 23 question 1, we are doing it. Question 2, you do it, right? September, December question 2, we are discussing. Question 1, you do it. March, June 21 question 1, we are discussing. Question 2, you do it. Okay, complete the past papers. That's something that I would like to recommend to you all. Right. So starting off with the question 1 of March, June 2023. All right, there are 3 requirements, right? So what are the 3 requirements? Let's first read the requirements. Prepare a schedule of adjusted profit for the year ended 31st December 2025, meaning there could be certain adjustments as necessary to the profit that they've already given. That's the first one. B, prepare Sphinx Core statement of changes in equity for the year ended 31st December 2025. And then C, prepare the statement of financial position of Sphinx Co. as of 31st December 20x5, right? So 3 requirements are first, a component of SPL. They have done that, but you have to adjust the profit. Then you have to prepare the statement of changes in equity, and then you have to do the statement of financial position. Whatever the figures in statement of changes in equity is what needs to reflect in statement of financial position. All right. So equity section of statement of financial position. That's something that you all need to remember. Okay. And as always, we are going to go note by note, working by working, and we will be trying to, in the working phase itself, we'll be trying to figure out, okay, which fulfills which of these requirements. There could be certain items that would be fulfilling all these three requirements at once. So do it there, then and there itself, right? So in the exams, when you all get into the exam, make sure you all prepare all the layouts or based on the requirements, and then start doing the requirements and adjust all these three requirements at once, because most of the questions that will be possible. Some questions that won't be possible, so there you all will have to requirement by requirement, but most of the requirements that are interconnected, please make sure that you all attempt or you all respond to each three of requirements at once, right? Meaning, for example, note number 1, if that fulfills either of these three requirements, park it, right, together. That's what we are going to look at. So we are not going to prepare the statement of changes in equity, statement of final position. That you all have to do from your side. We'll be doing that at the end. But as we go through, we will be looking at, okay, is this affecting the adjusted profit? Is this affecting statement of changes in equity? Is this affecting SOFP? That's what I am going to indicate while we do the notes or discuss the notes. And then at the end is where we will be preparing. But my recommendation to you all is, now since we are going to, in my case, I'm going to discuss it, take a little bit time to, make sure that whatever the requirements are, go into your head very clearly. We will be, at the discussion phase, we'll be discussing, okay, whether it's affecting first, second, third requirement or not. So when we discuss that, you all will have to figure out, okay, if it is affecting all three requirements, let me do it at once, right? So that's something that I want you all to do together with the requirements fulfillment or the notes discussion. But from my side, I'll be doing the notes discussion first, and then we'll be preparing the statement of changes in equity. All right. Okay. So here it's very clear that there is an adjusted profit that's required, swings, goes, changes in equity, and financial position. Right. Now, let's just have a look at the trial balance. Let's see what they've given here, right? So they've given land and buildings, plant and equipment, accumulated depreciation is given, inventory, trade and other receivables, trade and other payables, bank, current tax payable, so loan notes, equity shares, share premium, retained earnings, right? So now this should be an indication that these three items will be there in your statement of changes in equity. All right. Then here goes the draft profit before taxation. Now, this is going to be the starting point of profit adjustment. Okay, this is going to be the starting point of your profit adjustment. Okay, this is going to be the starting figure. Right. A, adjusted profit, right? So starting point is going to be the draft profit as per trial balance. All right. So you go there, pick it from the trial balance itself. Right. Then the rest of it, you will have to read the notes to understand and figure out. Okay. Now this is going to be the answer. This is going to be the working tab, right? This is where we're going to do the workings, and that's where we are going to give our answers, right? Then let's leave some space for the profit adjustment. Then we'll do the B. Statement of changes in equity as at date. Okay, as we read through, we'll understand what's going to be the date. Then leave a little bit more space. C, statement of financial position as at date. We'll look at the question and note down the date here. Remember, there are easy marks, which is just pulling numbers from trial balance. That's going to be easy marks. So please make sure you all pull those numbers, and then doing workings based on notes is going to give you all the technical marks, more complicated marks, but easy marks first, right? That's from your side, you'll have to do, right? Now let's start off with the note. So each note I'll be taking as a separate working, right? Working number 1, right? Working number 1. Right. Until 1st of January 2025, Sphinxco held land and building at cost. On 1st January 2025, Sphinxco had them valued at 250 M. Right. So it's plants and machineries, depreciation, valuation. Okay, that's what's the standard. Quickly, you all have to figure out what the standard is first. IAS 16. So you have to keep your heads revolving around IAS 16. Quickly, you all have to start recalling the IAS 16 theory or IAS 16 standard requirements. Okay, that's a PPE. And this is going to be a part of multiple sections, mainly the non-current asset, but the depreciation, the SOPL, meaning profit adjustment, might have that requirement. And then saving of change in equity, the revaluation, right? So here they're talking about the valuation, right? So revaluation, saving of change in equity. What is it? Revaluation surplus. So we get that into our head that this is going to affect all three requirements, right? So what we'll do is we'll start working on the PPE schedule, right? So first we have the cost schedule. Then we have the accumulated depreciation schedule. Accumulated depreciation schedule. Then we arrive at carrying amount. I'm leaving a little bit extra space because we don't know how much space will be required. But based on, the responses, we may do the space adjustments, right? So what are the elements? Land, building, that was the first element that we saw. And then they're talking about plant and equipment, right? Depreciated. So quickly grasp, you have the understanding of grasping information as quickly as possible. And equipment, right? So how does the schedule work? You always have the as at 1st of, let's quickly have a look at the data right now. December, right? 1st of January 20x5, 31st December 20x5, right? As at 1st of January X5, that's the opening accumulated depreciation, right? Then there is opening cost and opening accumulated depreciation here, right? Right. So let's quickly plug that through. Right. Until 1st of January, Sphinxco held land and buildings at cost. On 1st of January 2025, Sphinxco had them valued at 250 million, of which 80 million related to the land. No entries have yet been made to incorporate this valuation. 250 million has been the revaluation. Therefore, revaluation is relevant to both land and building. Building element, you have to calculate because land element they have given. Okay, right. Let's quickly look at the revaluation component. Now, these are costs, huh? Land and building at cost, plant and equipment at cost, right? Land and building at cost is land 50 million they've given in the brackets. So always try to incorporate that. I mean, or read through the responses because building is going to be the balance equals this minus this, right? That's the buildings element. Plant and equipment, we go back to this and we can see the plant and equipment cost. Now that is the cost that we have to get here, right here, okay? Accumulated depreciation, how much is that? How much has that been? Land is not depreciated, so that's going to be 0. Land is a non-depreciating asset. Buildings, they've given here 90,000, right? And then plant and equipment also has been given, which is 111,200. Okay. So what has been the carrying amount as per this? Minus this. right? So this has been the carrying amounts. All right. These has been the carrying amounts. Now, what are the other components that are going to affect here? There is a revaluation, right? There is a revaluation. Now, revaluation, how are you going to figure out what has been the revaluation? Now, revaluation is for land and building element, right? Plant and equipment, there's no revaluation, okay? So what we'll do is let's delete all these lines and let's work on item by item basis. That would be easier, okay? So depending on the question, you have to adapt, you have to adjust, okay? Right. Right. Carrying amount is 50,000. Let's just leave a little extra space here. It's a little extra space here. Right. Okay. Right. So now they are saying there is a new amount. Revalued amount. Right. So what is the revalued amount of land? In the note, they're saying land was 80 million, 250 million the total revaluation. So 80 million pertaining to that is land, 80,000. 250 million minus this is going to be the revaluation of the building. Okay, that's going to be the revaluation of the building. Okay, right. So that's the fair values. So what do we have now? There is a difference, right? Difference between the carrying amount and the revalued amount. That would be your revaluation gain. How much is that going to be? This minus this. Same thing goes to the next one also. Revaluation gain is going to be your revalued amount minus the carrying amount. So that's 110,000 and 30,000. Total revaluation gain of 140,000. Okay, that's what the revaluation gain is. Is that clear, guys? Right. So once the revaluation happened, what do you need to do? Now remember, what's the date here? When did the revaluation happen? 1st of January. All right. When is the year end? 31st of December. The revaluation has happened in the beginning of the year. So depreciation, subsequent depreciation needs to be calculated on the revalued assets. How do you identify subsequent depreciation? How do you calculate subsequent depreciation? Now that they're saying is straight line basis, right? Prior to the revaluation, buildings were being depreciated over 50 years on a straight line basis, right? 50 years on a straight line basis. Buildings have a remaining useful life of 20 years as at 1st of January 20x5. Right? 50 years was where the straight line depreciation was happening. And now what has happened is now it has remaining life of 20 years, right? There's one more line that says, SpinxCo has a policy to make an annual reserve transfer in respect of the additional depreciation charged each year. Now, this is where the depreciation prior to revaluation and depreciation post revaluation is important. We need to compare both of those, and whatever the difference is, that's what you're going to transfer from your revaluation reserve to your retained earnings. All right, IAS 16. I hope you all know the theory behind this. Why that happens? In case, now these are choice. If a company chooses to do this, they can do this to eliminate the effect of revaluation based excess depreciation. Okay. If you all cannot recall what I'm saying, please make sure you refer to IAS 16 notes. All right. No, Azmat, I had shown you last week, right? I typed, I mean, on the ACCA website itself, there is going to be an area of examiner reports. There's a section of examiner reports where you can review it. So even on Google, you type FR examiner reports, it'll take you, the ACCA FR examiner report will take you to that, the link. All right. Okay. So there is quite a bit of an adjustment that's required here, right? The deferred tax is also there. There is a couple of standards that are being tested here, not just IAS 16. IAS 16 is also being tested. What's the other standard that's being tested? IAS 12. taxation, right? Two standards in the first note itself, right? Deferred tax. Then there is depreciation, plant and equipment, reducing balance, and then the building. So that's straightforward. There's no change to plant and building. No. So plant and building, you know the carrying amount, and based on reducing balance method is carrying amount into the percentage. So carrying amount into 15%. What's the carrying amount? 208,800, right? So what's the depreciation for the year? Depreciation for the year. First, you do the straightforward adjustment, which is this into 15%. Okay. I hope this Zoom is sufficient, right? So that's straightforward depreciation that you're able to calculate. And now the revaluation base subsequent depreciation is going to be based on the remaining number of life, remaining useful life. So what's the remaining useful life here? What's the remaining useful life? 20 years. That's what it's saying here, right? 20 years as at 1st of January. So you're going to do it on 20 years. What on 20 years? 170,000. This divided by 20. Now that's the depreciation for the year. Okay, that's the depreciation for the year subsequent. So let's break it down, depreciation, and let's break it to subsequent depreciation. So it's clearer to you all, right? You all can use any format as far as you all can present it clearly. Depreciation for revalued asset. This is divided by 20, right? That divide by 20. So now what is going to be the carrying amounts, right? Carrying amounts as at 31st. Carrying amount as at 31st December X5. What's going to be the carrying amount? Anyway, you should know that there is no depreciation here. So land goes as 80,000 itself. This, there is depreciation, this minus this, right? And then this is going to be this minus, okay, 177,480. So what's the total? Total PPE. Where will this go? SOFP. Where will this go? SOPL. Where will this go? SOPL. Okay. This is where that's going to go. And then where will this go? Revaluation gain, statement of change in equity, as well as other comprehensive income. So other comprehensive income component. Now there is deferred tax. Remember IAS 12 deferred tax we saw in the note. It says deferred tax on revaluation is calculated at 20%. What does IAS 16 say? Or what does IAS 12 say? The deferred tax can, now what you all need to remember, for FR purpose, deferred tax, the temporary difference would arise mainly from the revaluation of non-current asset, and that is what has happened here. And when the revaluation of non-current asset deferred tax is calculated, that deferred tax also goes, deferred tax is also recorded where the revaluation gain is recorded. Okay. Now, for example, if revaluation surplus remains under other comprehensive income, deferred tax is also going to be a component of other comprehensive income, right? So, statement of change in equity, you are going to transfer the net amount, net of deferred tax. That's what is going to go to your statement of change in equity, right? And if this surplus has reversed a previous revaluation loss on the same asset, that is going to be recorded in the statement of profit or loss, right? So the amount or the component that's being recorded in statement of profit or loss, the deferred tax also will go in statement of profit or loss. If there is excess to the loss, that goes statement of change in statement of other comprehensive income. So that deferred tax component, that little component will go under statement of other comprehensive income. Now that's for your knowledge purpose. You're not going to be tested at that depth of technicality, but what you all need to remember is if there's a deferred tax on revaluation, deferred tax is also considered as a part of other comprehensive income. You net it, and that figure is what is transferred into your statement of changes in equity. Okay? Right. So what's going to be the deferred tax? Deferred tax is going to be 20%, right? 20% of the revaluation surplus, total revaluation gain. Let me move this. I'll just take the total revaluation gain here, plus this, right? SOCIE and other comprehensive income, right? Now, what's going to be deferred tax? That's going to be this into 20%. Depreciation happens only on buildings, but deferred tax happens on total revaluation. You know, remember that. So what is going to be your revaluation reserves? Net of, this is your total revaluation surplus minus your deferred tax. That's going to be your revaluation reserve, right? Deferred tax, how are you going to show the deferred tax? Statement of financial position, non-current liability. Why? It's a long-term asset. So until it is sold, it won't be realized. So you should know, okay, it's beyond a year. So non-current liability, right? Revaluation reserve, statement of changes in equity. And through that, it's going to go under statement of financial position, right? So it's affecting both of those items, right? And then there is annual transfer of excess depreciation. How do you do this? How do you do this? Now, to do this, there's a small calculation you will have to do, right? Depreciation pre-revaluation. It's not per, it's pre. Depreciation post revaluation, meaning before revaluation, after revaluation. So that's the difference is what you're going to take. So the cost, how much is the building cost? 150,000 over 50 years, right? That's what they told me. 150,000 divided by 50 years. Okay. And then the depreciation after we already have calculated. So what's the difference? This minus 5,500, meaning now you are charging 5,500 extra depreciation, additional expense, meaning your profit has gone down by 5,500. So retained earnings are undervalued by 5,500 because of this unrealized or revaluation impact. Now you have made the choice of transferring that revaluation reserve from your revaluation reserve, the excess depreciation from your revaluation reserve surplus to your retained earnings. So now what you are going to do is this 5,500 is going to be a transaction that's happening within SOCIE. Okay. So what will happen? You are going to credit your retained earnings and you're going to debit your revaluation surplus. Okay, that's what you're going to do for annual transfer of excess depreciation. Right? So what's the total depreciation? Total depreciation. What's the total depreciation? This plus this. Now that's going to affect your SOPL. All right, total depreciation, SOPL. PPE. What's the figure that's relevant to PPE? 418,980. That's going to be a part of your SOFP, non-current asset. Right? Is that clear, guys? Is that clear? Is that clear? Does that make sense? Quickly confirm. Guys on YouTube, is that clear? Please confirm. Any questions so far? Any questions so far? Or are we clear? Quickly tell me. Clear? Super. Right. Now let's quickly go here. This is the first note how that's going to affect, right? Depreciation based on working one, right? Always give reference to working one. Now do the working, then give the reference to the working one, right? So there are two items. There is building depreciation and there is plant and equipment. It's always good to show them both separately. You all can even show it together, but showing separately always is going to help you gain more marks. Right? Minus draft profit. From profit, you're going to reduce it, then expense. So it's going to deduct the profit. It's going to reduce the profit. So minus 8,500. Plant and equipment minus 31,320. That's working one. Right. Let's quickly look at how that working one is going to. Shall we do everything together or do you all want to do it at the end? Quickly tell me. Do you all want me to do everything, all the requirements together? So that gives you all a better idea in the first question how to do that. So next question onwards, you all do it together. Or you all want me to discuss and then do it at the end and you all will be doing together. Quickly confirm what you all want me to do. Together, right? Okay, fine. So let me do it together. Let me quickly put the format here. Opening, right? So what are the items? There is share capital. There is share premium. Please don't mind the spelling errors. You all also should be used to not going back and correcting your spelling errors, unless it's very impactful. Like for example, the per and pre, right? So such spelling errors you may have to correct, but otherwise don't think about spellings, right? Retained earnings, right? Retained earnings, and then there is revaluation surplus. These are the items that we have to take into consideration. Always opening, where do we get that from? Opening, we always get from the trial balance. So opening one, but is that's closing, right? Closing. So let's come back to that. Let's leave that for the empty for the moment. So whatever is relevant, let's do those adjustments, right? Total comprehensive income, right? Total comprehensive income. Now, retained earnings is going to have the total profit. So we are keeping that empty for the moment. But we have the revaluation surplus figure that we take from here. 112,000 is a revaluation figure. Then there is reserve transfer. That also we have the figure. From retail, from this, we are going to deduct this figure. And we are going to add it here. Right? Okay. Now this is going to be the final figure here. Okay. The final figure, that's going to be the profit for the year. Let me put the final figure here. Or let me put one line below in case we have more workings. Profit for the year. Okay. So let's put the formula and keep. We all also need to, when there is Excel given, please make use of the formulas in the exams also. That's going to make your lives easier. If you'll already give the reference and keep, be easier. Okay. Enter. And you give the reference of total retained earnings, total comprehensive income of this. As we do more adjustments, we will see that this figure would change. But total comprehensive income will automatically be captured. Right? Okay, statement of financial position. We have non-current asset. Right? Under non-current asset, we have PPE. Then we have current asset. Let's leave some lines for safe side of it. So what are the current assets that we have here? Trade and other receivables have been given. Inventory has been given, right? Inventory, receivables. Then let's leave some more lines. Then we move on to equity and liability. Okay, equity. So here we can give reference to this. Share premium, retained earnings, revaluation, surplus, right? Now here we'll leave some lines and put the final figure, 31st December X5, right? So that's going to be equals sum. So you see what I'm doing? I'm making my life easier at the exam by putting all the formulas and keeping so that I will not miss anything at the end and I won't have to bother to keep doing the calculation at the end. Okay? Fill. Right. And this is going to be the sum of this. Okay? Right. And as I go here, equity under share capital, again, I'm going to give reference to the total figures because that's what I need here, right? Own figure rule, in case you have gone wrong somewhere and say you have changed an equity, but if you pull that figure here, you are getting the mark there. You'll only lose the mark at where you went wrong. But here you are going to gain the marks. Okay, don't worry about that. Then PPE, we already have the answer for that. PPE, we already have the answer, which is this. Then we have the non-current liability, and that we have deferred tax already. And then what are the items they've given here? There is loan notes. Loan notes have been given here. Right. Person loan notes. Okay. Right. And let's leave some more spaces. Current liabilities. So they have current tax is there, right? Tax payable and trade and other payables is there. Bank on the credit side. Bank on the credit side, meaning bank overdrafts. That's a liability. Okay. Right. Any other liabilities here? No. So there's payables, current tax, and bank OD. Payables, current tax, bank OD. Okay. All right. So certain items you can just pull, but since you have already prepared this and kept, you know at the end what you need to pull and what you don't need to. Deferred tax, we already have that figure as well here. There we go. Okay. Any changes as we go into other notes, we can make the changes accordingly. All right. Right. That's working one, number one. Is that clear? See, no depreciation for any assets has been charged, which is why we are making the profit adjustment. Had they charged it, we had to make only the additional, the revaluation, which was not done. But here they have not done for anything, which is why we have to record both the buildings and plant and equipment. Always read the requirements clearly. Is that clear, guys? Right. Shall we move on to the working number 2? Note number 2. That brings us to working number 2. Okay. Working number 2. Okay, that's working number 1, working number 2. Right. On 31st of October 2025, Sphinx Co. acquired inventory from an overseas supplier on credit for 40 million dinars. The invoice was paid in full on 25th January 2026, meaning after the year ended. Sphinx Co. had correctly recorded the purchases on 31st October 2025, but no further entries have been made at the year end. The following exchange rates are relevant. 31st October, 31st December, 25th January. What's the standard? What's the standard? IAS 21, foreign currency. Okay. So when they talk about foreign currency, what should come to your mind? Monetary, non-monetary, translation, right? Inventory was purchased, acquired from overseas supplier. Inventory is a non-monetary item. But on credit, payables is a monetary item. So what do? Non-monetary item, you recorded historic cost, no translation. But monetary item, you have to translate at the year end, at the year-end rate. Okay, right. Let's quickly do that translation part of it. Right, let's do that translation part. Right. So when did the purchase happen? 31st October 20x5, right? So what's the year end? December 20x5, right? October x5, December x5, right? Dinars transaction value based on dinars. So we need that. Exchange rate. Then we have the total in USD. All right. Okay. So on 10th of October, quickly tell me what was the exchange rate? 4 dinars. On 31st December, 5 dinars. We have to take those figures. Right? The next, why don't we take 25th January? That's going to be relevant to the next year, 2086, when the settlement happens. Again, there'll be an exchange rate difference, which will be based on this. But for this year's translation, this year's impact, this is not going to be relevant. So we're taking only 4 and 5. 4, 5. Right. 40,000 has been the transaction. 40,000 remains at the year end. Had there been a payment, there would have been a settlement date base, but here there's no payment. It's straightforward. Whatever the credit remained credit until the year end. Right. So what was the right dollar? You're translating dollar. Huh? What does this say? $1 is 4 dinars. So you have to divide by 4 in order to arrive at 1, right? So always remember how to exchange. Had they told 1 dinar was $4, then you have to multiply. Right? So here in 4 dinars was $1, so you have to divide. Okay. So you have to be very clear about the multiplication division rule. This divided by this. Now, when the payable happened, you would have recorded $10,000 as the payable. But at the year end, you now have to record $8,000 as the payable, right? So in the trial balance, there would be $10,000, right, of payable. But $8,000 is what you have to write it down to. So it's a gain, right? Your payable goes down. So it's a gain. What's a gain? Exchange gain. How much is that? Minus this, right? Now, what are the areas that this is going to impact? This is going to affect? This is going to affect both SOPL, which is your profit figure, profit before tax adjustment, right? So SOPL. And your payable will go down. Payable is a part of it, SOFP. SOFP. Right? So it's going to impact both your SOPL and SOFP. Right. How is it going to affect here? Foreign exchange gain. Exchange gain adds to profit, right? Increases your profit. So add it. Remember how the addition and deduction works. Huh? Working to always give working reference. Okay. Right. How much is that? 2,000. 2,000. Right. Now, when you go to your payables, then you go here, remember, you pull your payables figure from the trial balance, right? Payable figure from trial balance, and you deduct, you're reducing your payable value by this figure. Then any further adjustments, we can do it on that payable. So for the moment, let's keep it as it is. Right. Is that clear, guys? IAS 21, is that clear? Quickly confirm, is that clear? Is that clear, guys? Can we move on to the third working? Can we move on to the third working? Yeah, clear? Super. Right. Note number 3. On 31st of October 20x5, okay, that's note number 2, sorry. Note number 3, interest on the loan notes is paid every 6 months with the next payment due on 1st of January 20x6. The draft profit before tax figure in the trial balance includes the first interest payment on the 7% loan notes made on 1st of July, meaning every 6 months. How many months does a year have? 12 months. What has been recorded in trial balance? For 6 months. What has not been recorded in trial balance? The next 6 months. So what has to be recorded? The 6 months figure. Okay, remember, not full year, 6 months figure. Right, so that brings us to working note number 3. Low note. When you talk about low note, what's the standard that comes to your mind? What's the standard that comes to your mind? It's a financial instrument standard. So we have multiple standards there. IFRS 9 being one of the most important standards. But this is not testing IFRS 9 in detail. Rather, it's just your knowledge about interest calculation that is being tested here. Right? Accrued finance income, meaning what is not paid yet. Okay? But expense have been incurred. Right? Right. So what has been the loan note figure? What has been the loan note? Let's quickly pull the loan note figure from here. There we go. 30,000 is loan note figure, right? What is supposed to be the interest? It's a 7% loan note. So this into 0.07. That's supposed to be the interest. But 6 months have already been recorded. What has not been recorded? Accrued 6 months. Right? 6 months. Okay. Accrued finance interest is for 6 months. And that is the figure that is going to affect here. Now, how is this going to, or what are the areas this is going to impact? SOPL. SOPL, why? Accrued finance income is an expense. Only 6 months have been recorded. 6 months you have to record. And payable also increases by this figure. Payable also consider only for 6 months. So this 6 months also you're payable, right? So that's going to impact your SOFP as well. Right? SOFP. Right? Okay. Quickly, let's go and do let's quickly answer it. So far there is no statement of change in equity impact. Therefore, whatever is impacting anything, that is what we are going to deal with. All right. So remember, whatever impacts anything, that is what we are going to deal with. Okay. Accrued finance cost. Working 3. Always give that working. This is going to reduce your profit. Therefore, minus this, right? Minus. And then payables, there's another adjustment, which is plus. You have to increase your payable by this amount. Okay. Is that clear? Is that clear? Quickly confirm, is that clear? Can we move on to the next note? If that's clear, we can move on to the next note. Is that clear, guys? Quickly confirm. Guys, please confirm. YouTube, online. Is that clear? Can we move on to the next note? Or do you all need more clarification there? Quickly use the thumbs up if we can move on. Azmat, Amani. Quickly use the thumbs up if we can move on. A little quick.
So could you go through that again?
Sorry?
You go through the accrued expense again.
You want me to go through it again?
Yeah.
Okay, fine. Right, so let me explain that once more. Interest on the loan note is paid every 6 months, right? With the next payment due on 1st of January 2026. The draft profit before taxation figure in the trial balance includes the first interest payment on the 7% loan notes. Only first interest payment is there, right? So what you have to do when there's only first interest payment, which is only for 6 months, right? But you have to record interest payment for the entire year. Yeah, that's clear. No, you have to do the interest payment for an entire year. Okay. But what has happened in the trial balance? It's only for the first 6 months. Your profit before tax, only for 6 months. Payables, only for 6 months. Right? So this is how you do. Loan note was 30,000, 7% loan notes, total interest for the year should have been 2,100, but 1,050 has already been recorded, means 6 months already recorded. So unrecorded, accrued finance income, which you will be paying in January, 1,050. So that you are going to deduct from your profit because that's an expense, right? Which is not recorded. Trial balance figure does not have that. So record that, deduct the profit before tax, and you are going to increase your payable because you will have to pay that, right? So you're increasing your payable. Hope that's clear, Azmat. Yeah. If still it's not clear, please reach out to me. Yeah. Right. Superb. Note number 4. Next note, note number 4. A provision for income tax of $30 million is required for the year ended 31st December 2025. The balance on current tax represents the under or over provision of tax for the year ended 31st December 2024. Okay. What's the standard? What's the standard? Working number 4. Right? What's the standard? IAS 12, right? IAS 12. Right. So they've given you now here. What are you supposed to calculate? You're supposed to calculate the income tax expense, right? So they've given the provision, which is the estimate for the year. Then there is under over provision, right? So what's the current tax? Current tax stays at debit, right? Debit meaning it's you have under provided, so you have to add that. Debit is always an expense, meaning you have to add that. You had under provided last. If it's credit side, it's over provided. You deduct that, right? So under provision of tax. Now that is going to be relevant to your tax working, income tax expense working. Okay. Right. Income tax estimate payable for the year 20x5, 30 million, right? That's what they're saying here. Yeah. 30 million, right? 2,500, 2.5 million is an under provision. So what are you supposed to do? Under provision. Add income tax expense. Expense is going to be the total. This is going to be relevant to your SOFP. This is going to be relevant to your SOPL. Okay. That's going to be relevant to your SOFP, and this is going to be relevant to your SOPL. Again, it's going to impact both your SOFP and SOPL. Right. Let's leave a line there. Income tax expenses. I'm assuming there is no more calculation. Income tax is always deducted, right? Minus this figure. Go down. Current tax is always a current liability. Go here. $30,000. Yeah, that's the adjustment. Okay, that's the adjustment. Remember, 32,500 is going to go as income tax expense, but 30,000 current year's tax payable tax estimate is what is going to go as the current tax payable. Remember that. Okay, that's what IAS 12 says. Is that clear? Working number 4 done. Again, always give reference to the workings. Even if I forget, you all don't forget, right? What happened there? Info, right? In case I forget, make sure you all don't forget, right? Final note, on 1st September, Sphinx Co made a 1-for-5 rights issue at 1.25 per share. The rights issue was correctly accounted for on 1st of September 2025. The shares are included in the trial balance above. Now see, this 120,000 figure in the trial balance includes the rights issue, meaning the statement of change in equity component of this is 120,000. The closing balance is going to be 120,000, right? Now you need to understand what was the share issue. Rights issue is going to be split among share capital and share premium. For that, you have to first figure out what was the total share issue. Now to do that, how are you going to figure that out? Working number 5. Again, shares, financial instruments, though it's not testing that standard. Whatever standards we are putting in here, please make sure you all at least read that and get that understanding. All right. Okay. Now here what we are supposed to do is we are supposed to figure out, do a reverse calculation, right? Reverse calculation, right? So number of shares in issue as at year end. $120,000, right? How much is that? 120,000. Equal each other, $1 each. So 120,000. 1 divided by $1, it's 120,000 shares. Or let me take this, divide by 1. It's 120,000 shares. Okay. Now remember, this 120,000 is having 1-for-5 rights issue, meaning there are 6 shares. Right? There is 6, meaning you to know what was the share issue before the rights issue took place, you have to divide this by 6, meaning 1 additional rights issue, and multiply by 5 to arrive the original, right? Original is 5 shares, right? 1 for 5, right? So how do you arrive at it? Original, meaning number of shares in issue as at 1st of January, meaning opening. 1st of January x5. How do you arrive at that? Take this, divide by 6, multiply by 5. You want to eliminate that rights issue, right? There you go. Number of shares in issue before the rights issue was 100,000. So how many additional shares were issued? Shares issued during the year. We are doing a reverse calculation. During the year is 20,000, right? Now, what was the rights issue value? $1 is the par value, but rights issue happened at 1.25. So $1 is share capital, 2.25 is share premium, right? Share issue to 20,000 shares. Share capital component, this into 1 share premium component, this into 0.25. That's a share issue. Okay. Now that's going to impact the statement of changes in equity. Let's quickly go here. Now we have the opening figure. We know what the opening figure was. 100,000 into $1 was the opening figure, right? Share premium, there was nil. Share issue, we have that figure. Share issue was 20,000. Share premium, 5,000 during the year. We pull it from here, right? Right. So that gives us the total statement of change in equity of 120,000 of share capital, 5,000 of share premium, retained earnings. Okay. Retained earnings. Do we have the figure here already now? 95,080. But have we taken the opening retained earnings from the trial balance? Right? What was the accumulated retained earnings already? Need to figure that out. Retained earnings on 1st of January. This was the opening retained earning figure. Right? 258,730 is the retained earning. Revaluation is 106,500. Has that been captured? Now, what is the profit for the year? After all the notes, now we have all the answers with us. What's the profit for the year? Profit for the year is, give me a moment. Profit for the year is 95,080. What is statement of change in equity? Total of 492.30. Right now we can fill the rest of it, because rest of it there is no any additional notes that's relevant here. Inventory we can pull from here. Past paper, right? So easy marks. These are all easy marks. We just have to pull it from here, 115,000 directly, and then this also we directly pull from here. Easy marks, no working to be done. So those are the easy marks I was talking about, right? Total non-current assets, current assets, this plus this. So what's the total assets? Total assets is non-current asset plus current assets. That's your total assets, right? Then your total equity, how much is total equity? Sum, right? Total equity is the sum. Again, it should balance to your, it should be equal to your 492.30, to your this one. Matches 492.30. We are right there. Deferred tax 28,000 is there. 7% loan notes we take directly from here. 7% loan notes we take directly from here. The trial balance. That gives us the total non-current liability. It's a C-part question, yes. So we are discussing, we plan to discuss 3 questions today, right? Bank overdraft, there was no adjustment there. We'll put it as it is. Bank overdraft, how much is that? 16,200, right? That's the bank OD. So what's the total current assets? This plus this plus this. Right. Total equity plus liabilities. How much is that? Total equity is this. Or let's first figure out the total liabilities. This plus this is your total liability. Right. Total liability. Let's put it down here itself. Total equity plus liabilities is this plus your liability. Is that match? Does that balance? Yes, that balances. There we go. And liabilities. So remember, there are going to be easy marks that you can accumulate as you all proceed. Please make sure you all don't miss on that. Huh? Timing is the key. You need to be very particular with time. As far as you all do the timing clearly, you all are going to get it balancing. Is that clear, guys? Is that clear? Is that clear? I have not shared, but I told you about the questions. March, June 23, question 1. September, December 22, question 2. March, June 21. So there are three past papers. I've selected certain questions that I felt could bring you all a different perspective. Right? First question, yeah. But anyway, you can watch on YouTube whatever you miss, because that's already live. I told you last week was on the way. You can always keep an eye there. Right. 20 marks in section C. Always remember how you allocate your timing. 100 marks paper, 3 hours for 3 hours, right? 3 hours meaning 180 minutes. 100 marks, 1.8 minute per mark. A 20 marks question would require you to spend 36 minutes. So always under time. 36 minutes meaning try to finish it in 30 minutes so that you have additional time. Never go 36, don't make it 40. Make 36, 30 so that you'll be able to remain within time and you'll have more time to come back. At 30 minutes, stop, move on. Because towards the beginning is where you're going to accumulate a lot of marks. Towards the end, you're not going to accumulate a lot of marks. So if you spend time, you are going to sacrifice your precious time for the next question. You will end up you're risking not completing the next question and earning easy marks there. So please make sure. No, this is just for one. Section C, there are 2 questions, 36 for one, 36 for the other one, right? 40 marks question, section C, yeah? So you always have to spend time according to the marks, right? Now, here also there could be subsections, right? Now, these could have their individual marks, right? So adjusted profit could have its own mark, B could have its own marks, C could have its own marks, right? But now, since we did all of these together, we were able to use the timing effectively, right? Now, I was explaining, still we were able to do this effectively, right? But when you all are having a clear mind, doing it, practicing it, you all will be able to manage time. Time management is key because there are so many students fail just because they were not able to manage time. They figured out there were easier questions, easier marks, but they could not do that. Why? Because time was the enemy. Time is going to be your enemy if you don't use it effectively. Is that clear, guys? Is that clear? Yes, Azma, there is going to be a timer that's going to be there, that's going to be running in front of your screen. You can always feel free to keep it running, or you can even hide that, but keep it running so that you will remember, okay, now I need to finish this. Okay. Right. Take 2 minutes, 2 to 3 minutes to absorb what we just did before we move on to the next question. Take 2 minutes to absorb what we did before we move on to the next question. Yeah. You can quickly set up your laptop, open the question. Guys, remember the goal should be SOFP matching or balancing, but even if it does not balance, don't be bothered as far as you are showing the workings and doing or giving your answers. All right. Okay, now there's a consolidation question. Huh? Right. So let's proceed on to the next question, which is September, December 2022, question number 2. Okay. Right. This scenario relates to 2 requirements. What are 2 requirements? Prepare the consolidated statement of profit or loss and other comprehensive income for the per group for the year ended 31st March 2028. Second one, calculate the total assets that would be recognized in the consolidated statement of financial position. They're not requesting you to prepare an entire consolidated statement of financial position, rather just the total assets section. Okay, right. So 2, and there are a couple of notes given. Yeah, there are 2 requirements. So let me give you my approach of approaching this. If you all find that convenient, go ahead with that. Right. So this you all do when you're reading the requirements, and then you all can use time effectively to plug them in. Right. First requirement is SOPL and OCI. Second requirement is total assets under SOFP. Those are 2 requirements, right? So this is going to be the answer sheet. Oops. Answer 2. Then we have a working 2 sheet, right? Working 2 sheet, right? So always again, before you all start your, before you all start attempting a question, quickly give a draft. Okay, now in that I did not mention the year end 31st. It's supposed to be as a 31st of December 20x5. So do that, all right? Okay. Consolidated statement of profit or loss and other comprehensive income for the year ended date, 31st, whatever. Okay. Then requirement B, total assets. Right. Okay. Consolidated statement, profit or loss, revenue. Right. Okay. Then you have, if you go to the question, you can see that they've given you the items. There's revenue, cost of sales, gross profit, operating expenses, profit from operations, investment income, finance cost, profit. These are the items that are given here. Copy. Yes. All that we are attempting are past paper questions. Okay. Now remember, when it comes to consolidated statement of profit and loss, there's one thing that's very important, key to do. You all might forget, right? You all might forget if you all keep it for the end. So do it alongside the question, I mean the format itself. So they want profit and loss and other comprehensive income as well, right? Other comprehensive. Working, as far as you're showing the working, you're going to get the marks, right? But you lose the marks for your statement of profit or loss, because there also it's going to give you, for example, if there's a working where you accumulate line by line. So moving into P&L also would have carry some mark. So you lose that mark, but the working mark, if you're showing it, you're going to get that, right? Working, please show it. That's only when you all show the working, you all will be eligible for own figure rule as well, right? So other comprehensive income and total comprehensive income. Then what you'll have to do? What you'll have to do? Profit attributable to, this is important. If you all don't do that, you are going to lose precious marks. Other comprehensive income attributable to parent. NCI, always parent is a balancing figure. NCI is going to be based on a working. Okay. Total comprehensive income, if you all want, you all can attribute that, but that is not necessary. What is necessary is to attribute both the profit and other comprehensive income. If time permits, just do this as well. Right? The space does not permit, though time permits. Right? So let's just forget that for the moment. Okay. Right, so you have created a format. Okay, now here also you all can create the form. You all can do the initial part of it. So PERD and Sebastian. So when you take total assets in SOFP, you have to line by line consolidation. PERD, parent. So when you go here, there you can see PERD acquired Sebastian, right? So PERD is a parent. Sebastian. Now this should be a starting point. They have given it here. You just pull it from the figure. PERD course total assets. This should be the starting point of your total assets. Now that's your format. That's your format. Okay, now you have drawn the format. Now you know, okay, I need to just fill it in. Okay, right. Now let's start reading. Yes, Amani, you are going to gain marks for all the workings that you've done. Final answer does not matter, guys. It's a workings. Even if you screw up a working, you get a wrong answer, you apply that answer. Now at that point, they will deduct the mark for the answer, but you'll be if you use that figure for the rest of the requirements, you'll receive own figure rule there, right? So you're going to gain marks. Okay, right. Now let's quickly start reading the notes and let's see whether it's affecting the first and second requirement, whether it's affecting only first requirement, only second requirement. Okay, right. Note number 1. The cost of PERD course investment in Sebastian Co. has been excluded from the total assets listed above. PERD course investment in Sebastian Co. has been excluded, right? As part of the consideration for Sebastian Co., 8 million is due to be paid on 1st of April 2028. PERDCO recorded a liability of 7.547 million in its individual statement of financial position at 31st March 2087, which correctly represents a liability at that date. No other accounting entries have been made in relation to this consideration for the year ended 31st March 2028. PERDCO has a cost of capital of 6%. Right. So there is a contingent, there is a deferred consideration, right? Paying in the future. So when there's deferred consideration, what are you supposed to do? You're supposed to take the present value of the future cash flows and you are supposed to unwinding cost. So that's going to affect your statement of profit or loss. Yeah. So this is going to not depreciation, unwinding cost. There's no depreciation, that's for assets. IA 16 unwinding cost is different. Consolidation unwinding cost is just unwinding cost, okay? SOPL, finance cost. Finance cost, yeah? Then total assets, SOFP, this is going to be a part of your goodwill, huh? A part of your goodwill. So they would have given, yeah, if they've given the goodwill figure, consider that part of goodwill, right? Right. So goodwill is what you're going to record on total assets, not this separately. Total goodwill is what is going to go as your total assets there. Next note comes to that, yeah. On acquisition of Sebastian Co., the goodwill was correctly calculated at 3.2 million, meaning goodwill is calculated correctly. They have considered that consideration also, right? So you don't have to consider that. You have to consider goodwill directly to your total assets, right? In the year to 31st March 2087, goodwill was deemed to have been impaired by 400,000. The further impairment of 300,000 is to be recognized for the year ended 31st March 2088. Impairment losses are charged to operating expenses, meaning there is operating expenses working. Another working that do for operating expenses, right? So current year's impairment loss is relevant to current year's profit or loss, right? Impairment, what goes to statement of profit or loss? Impairment for the current year, right? And total assets, you are going to consider the goodwill figure as well as and total impairment, right? Why? SOFP is and as at date, a position-based financial statement where you will have to show the accumulated figures. Total impairment as at date. Remember that. SOPL, only impairment for the current year. Goodwill, total impairment. Okay, right. Next note. At 1st of April 2086, Sebastian Co's property had a carrying amount of 11 million, but a fair value of 14 million. At this date, the property had a remaining life of 15 years. Sebastian Co sold the property for 15 million on 30th September 2087. For the year ended 31st March 2088, Sebastian Co has recorded the historic cost depreciation and historic cost profit on disposal of the property in operating expense. Depreciation is charged on a pro rata basis. Pro rata or pro rata, whatever. Give me a moment, guys. All right, guys, I want you all to attempt this on the practice platform. Please make sure you all open the practice platform, and by now you all should be familiar with practice platform as well. Okay, right. Now tell me here, the property has been sold, right? Property is disposed, sold. Is that going to affect your total assets? No, right? No, right? Total assets, no adjustment. Because already sold, you would already, de-recognized it, right? Now, what has happened here? Sebastian Coe has recorded historic cost depreciation, historic cost profit, right? But when you're consolidating, right, in consolidated statement of financial position, consolidated statement of profit or loss, are you going to take historic cost? No, right? Because you have to take it to fair value. You take all the net assets of your subsidiary and you revalue to the fair value. Okay, so they have given you the fair value of 14 million, carrying amount of 11 million. In Sebastian Coe's financial statement, Sebastian Coe has recorded it based on 11 million, but you have to do it based on 14 million. So there is going to be excess depreciation first that you have to adjust, right? What will you adjust first? The excess depreciation of fair value adjustment, right? Until the asset was in place. Why? Depreciation is pro rata. So you have to do excess depreciation calculation first in SOPL and OCI, and next is going to be the disposal, profit or gain or loss on disposal based on the fair value for consolidation. That historic cost is, meaning you have to eliminate the historic cost figures from Sebastian Coe, and when you have to consolidate the fair value based disposal. Okay, now those are all basic of consolidation theory or knowledge. Okay, right. So what is going to impact here? Gain. So Kaplan usually uses past paper questions, right? So whoever is referring to Kaplan, you might have come across some of these questions because Kaplan also uses past paper questions, right? But what we are doing purely is past papers. Okay, right. Gain or loss on disposal, that adjustment you'll have to do, and fair value adjustment based excess depreciation. Those are the two adjustments that this would require doing on your SOPL and OCI. Next, Perdco made sales of $9 million to Sebastian Coe during the year ended 31st March 2018. Sebastian Coe had only paid for 2 million of these goods at 31st March 2018. These sales were made at a markup on cost of 25%, and Sebastian Coe holds 1/3 of these goods at 31st March 2018. SOPL, yes. Intra group transactions to be eliminated. Does this affect total assets? Yes. Why? Sebastian payable. For Perd, it is receivable. Intra only 7 million is going to affect because that is only going to be there in your receivable. Intragroup receivable. And what else? What else? Unrealized profit impacts your inventory. Unrealized profit elimination is affecting both your statement of profit and loss and your total assets, right? Right. At 31st March 2018, the Perd Group decided to revalue its non-current assets for the first time. Perd Co's assets were deemed to have increased by 4.1 million. Sebastian Co's assets by 0.7 million. Closing inventory. So that's going to be there in your assets, right? So at 31st March 2018, the Perd Group decided to revalue its non-current assets for the first time. Perd Co's assets were deemed to have increased by 4.1 million and Sebastian Co's assets by 0.7 million. Neither company has recorded the revaluation in its individual financial statements. Ignore deferred tax. Does this affect your statement of profit or other comprehensive income? Yes, other comprehensive income, revaluation gain in other comprehensive income. Total assets also is going to, right? Revaluation gain or surplus, you can use any term. Revaluation gain would increase the non-current asset value. Okay, so that's going to affect both. Right. Final note. Sebastian Co. paid a dividend of 1 million in the year, which has been correctly recorded by both companies. Sebastian Co. has paid. It goes as investment income, right? The consolidation, it would be then per course investment income. So you have to eliminate. Yes. Eliminate from investment income only parent percentage. 1 million is total. So you take only parent percentage and eliminate. You don't eliminate 1 million in full, rather only the parent percentage. We don't need to show income. Yeah. 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 The investment income is 800,000 from. Yeah, so we have to eliminate that. Don't need to show. So we eliminate. But in working, you do it. Huh? In working, you put investment income 800,000 minus 80,000. You have to show that, right? Dividend eliminated. Okay. Right? Total assets, does that affect total assets? It affects equity of Sebastian Co. But not total assets. No adjustment. Okay, so now we know what affects both, what does not affect both. And now we can quickly figure things out. Working note number 1, right? Deferred consideration unwinding cost. Right, now working 1. Quickly tell me, what is the deferred consideration here? What was the deferred consideration? What is the deferred consideration value? Deferred consideration value was 7.547 million. 6% is the cost of capital. 7.547. 7.547. 6% cost interest rate. 6%. So unwinding cost. Unwinding cost is going to be this into 0.06. Now remember, when we look at this question, we have to quickly first look at whether was it a full year or mid-year. 1st of April, 31st of March, full year. So we can take it. We are doing the finance year calculation for this year. Yeah. 26, right? 1st of April 28, due to be paid on 1st of April 28, 7.547. Last is unwinding, you've shown on last year. This year's unwinding is showing this year. Okay, unwinding cost, profit, statement of profit or loss. Only the current year figures are going to be relevant. Is that clear? Yeah. Yeah. No confusions? Sure. Right. So what's the figure? Unwinding cost 452.82, 453. Right? SOPL finance cost. Okay. So when you take your SOPL finance cost, what will you do? You'll be adding, right? In your finance cost, you'll be adding this unwinding cost as well. Okay. Is that clear? Okay, let's quickly take finance cost here. Since we're doing it together, we'll figure the answer out here. Finance cost, they've given 3,240 plus 1,600 plus 4. There we go. Okay. Right. Working note number 2. On acquisition of Sebastian Co., the goodwill was correctly calculated at 3.2 million in the current year to 31st March 2027. Goodwill was deemed to have been impaired by 400,000. A further impairment of 300,000 is to be recognized for the year ended 31st March. Impairment loss is charged to operating expenses. So we have to do a working number. Now, this is not going note by note. This can go non-note basis. So we are taking operating expenses. Okay, we are taking operating expenses. Now, operating expenses, we first have to take the parents' operating expense. Then we take the, that's how we can consolidate. What's the parents' operating expense? 18,040. What is subsidiaries? 7,130. Right. And on this, impairment of goodwill. Expense you have to increase. So you are going to add. How much? 300 for the current year only. Right? But when you take total assets, what's going to affect the total assets there? What's going to affect the total assets there? You will see that goodwill will be added here and impairment will be deducted. How much? 700. Deduct. Okay? 700. Done with working note number 2. Okay? Right. Is that clear so far? Is that clear, guys? Make sense? Make sense? Online, can you confirm? Does that make sense so far? Can we proceed to the next note? Yeah. Right. So next note is going to be based on the depreciation, disposal working, right? So disposal working. So that will take as a separate working.
So it's easy to bring big transfer without transfer that way.
Yeah. It is easy that way. Let's do it that way. Okay. Disposal adjustments. Right. First, there is fair value adjusted depreciation. First, we'll deal with that. How much is that? 11 became 14, right? What is the remaining life? What are they saying about remaining life? The property remaining life of 15 years. Okay, 14 minus 11 equals 14,000 minus 11,000. Divide by, give me a second. $14,000 minus 11,000 divided by 15. Okay. Fair value, but are we taking it in full? Are we taking it in full? What does the question say? Sebastian had property on 1st of April. When did they dispose? 30th September 2027. How many months into the year? April, May, June, July, August, September. 6 months depreciation. Why? Depreciation is charged on a pro rata basis. Only 6 months. 6 months depreciation. Okay, that's what is relevant. 6 over 12. Okay, 6 over 12. And then what's the other adjustment? Other adjustment is going to be the gain or loss on disposal. Okay, right. So there are 2 models now. Cost model, fair value model. Right. So cost model, we have cost, we have accumulated depreciation. That gives you your carrying amount. then the disposal value, right? And that will give you your gain or loss. Okay, right. As per cost model, what was the cost? 11,000. Fair value model, what was the value? 14,000, right? How many years? How many years was the asset used? 1st of April 2026 to 30th September 2027. How many years? 1st of April to March, 1 year and 6 months, right? So 1.5 years, right? So that's 1.5 years equals this divided by 15 into 1.5 equals this divided by 15 into 1.5. Okay, so that's the accumulated depreciation. What's the carrying amount then? What's the carrying amount? Minus this. Carrying amount based on fair value model minus this 12,600. What was the disposal value? It was disposed for 15 million, right? 15 million. There is a gain, right? How much? Based on cost model, 5,100. Based on fair value model, 2,400. So what has been recorded in Sebastian's account? 5,100, right? But what you are supposed to record? 2,400. So you have to difference adjustment. What's the difference adjustment? 2,700. So what will you do with this 2,700? What will you do with this 2,700? Now look at this, what they're saying. Gain on disposal of property in operating expense. So when an income is recorded in expense, that becomes a negative expense, right? So when you want to eliminate a negative expense, you have to add it. Clear? Right. So what you're going to do? Gain on disposal, you are going to add. We are eliminating that, right? So that elimination would do the entire adjustment for us. Fair value adjusted depreciation, right? That's one item you're going to add here, which is 100. Then there is adjustment to gain on disposal. Yeah, but here they are clearly saying operating expense. So you do the adjustment operating expense. Don't assume, right? Remember, income is a negative expense. So negative expense reversal is an addition, right? So that's why you are adding the changes, right? Remember that. Okay. Adjustment to gain on disposal. Right. Then comes the next. Pertco made sales of 9 million to Sebastian Co. during the year ended 31st March 2028. Sebastian Co. had only paid for 2 million of these goods at 31st March 2028. These sales were made at markup on cost of 25%. You eliminate the asset is no more in the SOFP. It's derecognized, disposed. No adjustment there. Okay. Right. So Pertco made sales. First, let's do the total assets adjustment here, right? Eliminate intra-group receivable. How much? 9,000 minus 2,000. Okay. Equals 9,000 minus 2,000. So you have to eliminate that, right? Intra-group transaction, you are eliminating. Clear? Right. What else are you eliminating from here? What else are you going to eliminate from here? You are going to eliminate the unrealized profit, right? eliminate unrealized profit. Right. Now to do unrealized profit, we have to do a working. Right. So what's this working number? Working 3. Working number 4. Provision for unrealized profit. Right. What are details they've given here? 9 million was the sales. So this 9 million also has to be eliminated, right? From where? From revenue. Okay. We'll do everything together itself. This plus this minus 9,000. Okay. Right. Cost of sales will come to that after doing the working of unrealized profit, because unrealized profit is going to be relevant to cost of sales as well. Right. Okay. So 9 million sales were made at a markup on cost of 25%, and Sebastian Co holds 1/3 of these goods. Right. Revenue, cost of sales, GP. 100. What's the markup they've maintained here? Markup of 25%. 125. Markup always you'll calculate this way. What is the figure? 9,000. So what will be your cost of sales? Equals this divided by 125 into 100. So that's your cost of sales. What's your GP? 1,800. Remaining in inventory, meaning unrealized. Wait. How much? 1/3, right? What are they saying? How much remains? 1/3 of these goods. Okay. Right? Unrealized, how much? 1/3. Right. So what is the unrealized profit? How do you arrive at unrealized profit? You take this and you do the 1/3. How much? 600. So what are you going to do? You have to do a couple of adjustments here. First, you have to deduct that from your total assets. And then you are going to do the adjustment on your cost of sales. Equals cost of sales this plus this minus 9,000 plus 600. Okay, so that's your cost of sales. So that gives you a GP of, right. That note is also done. What's the final note? No, there's one more note. Revaluation, right? Decided to revalue its non-current assets for the first time. Pertco's assets were deemed to have increased by 4.1 million and Sebastian Co's assets by 0.7. Why do we need to have Sebastian separately? Because that's the only revaluation gain that's going to impact the NCI. Okay. Neither company has recorded the revaluation in its individual financial statements, right? Both the companies have not recorded the gains in their respective financial statements. So what you have to do is you have to consider the total gain here, right? In the answer, comprehensive income, revaluation, ignore. They've asked you to ignore the deferred tax, surplus, right? Revaluation surplus. How much is that? Equals 4,100 plus 700. So that's a revaluation gain. Okay, 4.8 million. Right. Operating expense, any other items on operating expense? No, right? So we are good to close operating expense working as well, yeah? Operating expense working also can be. No, that's going to affect NCI also. Let's come to that. Right, let's close the operating expense first. Sum. So this is your operating expense. Go to your answer. Pull it from here. Okay. Right. The profit from operations is going to be gross profit minus your operating expense. Investment income, 800 minus. Okay, let's do that working. I mean, let me just show that working to you as well. Right. Since we did not have to do the working number 5, dividends. What's the total dividends? Sebastian, co-dividends, 1 million. Parent percentage, which is 80%, equals this into 80%. Right, that's the parent percentage. So what do you do here? Go here, investment income. You pull this figure from here. They've given the investment income of 3 million minus working 2. Okay, 2,200 is your investment income after the adjustment. What's the finance cost is also given? What's the profit before tax? This plus this minus this. Right, that's 5797, round off to 5797.18, round off to 5797. Right. Tax, they've given the figures. There is no adjustment on tax, so we pull the tax as it is from here. This 1,560 plus 1,480. That's your tax profit for the year. 3,040. 3,040 tax, 2,757 is your profit for the year. Okay. What's the total comprehensive income in that case? This plus this. Right. Now for profit attribution, what do we require? We require something profit attribution, right? Can we close the total assets working? Can we close the total assets? Yeah. Final adjustment here, which is the revaluation gain. Evaluation gain. Why? We go back here. We saw in the note, revaluation gain would increase a non-current asset, right? Go here and bring the 4.8 million gain. Okay. Now we can close off our total assets as well. Sum right, there is truck balance. Okay, there is small issue here. It's not 32,000, it's 3,200. Right, fine. Right. This is going to be your total assets. This is going to be your total comprehensive income. Now that requires us to do one more final working. What is that? Working number 6. NCI. That's the final working that we have to do. Now, when you do the NCI working, what you're supposed to do? You are supposed to take the profit for, now you need this for SOPL purpose, profit for the year of subsidiary, okay? And make the adjustment of subsidiary profit, right? What's the subsidiary profit here? 3,690. This is what is relevant there, right? And then you have to do the adjusted profit on disposal, which you had to deduct. How much was that? 4.7 million. Where is 2.7 million? Where is that? Right. And then what's the other adjustments? Fair value depreciation. Yes. Fair value depreciation is also relevant, right? Deduct, right? Minus 100, right? And then there is also goodwill impairment. Goodwill impairment, that also you deduct. How much? How much goodwill impairment? Right? Right. So now that brings us the adjusted subsidiary profit. Adjusted of Sebastian equals sum
So you can all equal.
okay, 590. NCI share. How much is the NCI percentage? 20%. The NCI share is going to be this into 20%, right? Then revaluation gain. Relevant here is 700. NCI share is this into 20%. There we go. Now we have answers for profit attribution. Go here. Profit attributable to NCI, how much is that? We have that here, 118. What's the OCI attributable to NCI? We have that here, 140. So what's going to be for parent? This minus this. Other comprehensive income, this minus this. Okay. Yep. That's about it. Is that clear, guys? Is that clear? What did we do? We answered the requirement A and B together. Right. Is that clear, guys? Is that clear? Did we understand that question? Did we understand that question? Now you see, those are some little approaches that you all can use. Now you see, since we have already noted down what's affecting what, you will not miss. You can always go back and check your notes. Okay, what is affecting what? Yeah. But again, time management is key. If you all feel like doing this is going to, get you to sacrifice time or forego the time management, then don't do this. Okay, don't do this. Now, there is an approach that I used to use whenever I used to read. Now, my reading time that I allocate, this was my reading time based activity, right? Then I start drafting and everything I draft at once, right? So there, once I have it, understood the requirement, once I noted down the requirement, now then I can go back and draft everything at once, right? This is an approach I use. But again, if you feel like time management is going to be compromised in your case, please don't. Clear? No, yeah, that's the CB platform has given the exam form. Right, perfect. Take 2 minutes or take 5 minutes now to absorb what we have done. Quickly just run through the notes, think through what we did before we move on to our final section C question for today. Then we move on to the break, and then we are going to do section A MCQs. Right, so today is going to be a little heavier and impactful day. Okay, take 5 minutes, quick 5 minutes before we proceed into the next question. How the preparation work? Feels better now? All set? I asked you also. I didn't study it yet. Rest of the areas are done. Study plan is. Study plan. I done them all. So yeah, that are the challenge. When you start finding these challenging questions easier, means right? You all might have never faced a proposal where you have to eliminate a cost-based disposal and whether the salary-based disposal. Answer this is okay. All the people ready to take any All right, guys, are we ready to move into the third question? Quickly confirm, guys online. Are we ready to move into the final question for the day? I mean, not the final question for the day, final section C question for the day. Guys online, please confirm. Oh, super. Right. Now, this question is going to focus on interpretation, right? We did not say interpretation, so now we are going to look at interpretation as well, okay? Right. This scenario relates to two requirements. Paystrico is considering the acquisition of a subsidiary in the catering industry, considering the acquisition. Two companies have been identified as potential acquisitions, and extracts from the financial statements of Cookco and Doveco have been reproduced below. Right? Cookco and Doveco are the two companies that are potential acquisitions, right? Okay, now you need to remember certain figures could be a certain way because those companies may want to look attractive, right? And be disposal worthy. Okay. All right. So there are some notes given, right? Notes that are going to be very important to analyze, right? So what are the requirements? Requirement A, adjust the relevant extract from DOCO's financial statements to apply the same accounting policies as COOCO and recalculate DOCO's ratios provided in note number 5. What are you going to do here? What are you supposed to do here? You have to change the policy, right? This is March, June 2021. Okay. Right? So you are supposed to apply, right, COOCO's policies to DOCO. Remember, not DOCO's policies to COOCO, but COOCO's policies to DOVCO. Right? So first you identify what are the different policies that they're using. Right? First you identify that, you make that adjustment, then you move into the interpretation. Okay? Right. Notes. Let's quickly identify the policies here as well, if at all they are relevant. DOVCO policy, COOCO policy. Right. Both companies are owner managed. DOVCO operates from expensive city center premises, selling to local businesses and the public. COOCO is a large wholesaler, selling to chains of coffee shops. COOCO operates from a number of low-cost production facilities. Okay, what does this? Why is this not relevant? It says that it's owner managed, meaning whatever the expenses, certain expenses could be manipulated, right? Because there's no any external party involvement here. DOCOs, where they're operating, what sort of an operators they are, one is retail, one is wholesale. They're giving a little bit of an insight about the background about these two guys or two companies, okay? On 1st of October 2026, DOVCO revalued its properties for the first time. Okay, DOVCO's revaluation model. Resulting in a gain of 30 million. The properties had a remaining useful life of 30 years at 1st of October 2026. DOVCO does not make a transfer from revaluation surplus in respect of excess depreciation. No transfer. Right? I mean, what are the adjustments that would have happened? Subsequent depreciation would have happened, right? COOCO uses the cost model to account. COOCO uses the cost model to account for its properties, right? So that's the first policy. Cost model. So what are you supposed to do? Restate DOVCO cost model. Okay. Right. Next one says COOCO charges the amortization of its research and development to cost of sales, whereas DOVCO charges the same cost to operating expenses. Next issue. Operating expenses, meaning it makes operating profit look different. COOCO in cost of sales, meaning GP may look different there, right? Cost of sales impacting GP, operating expenses impacting the profit, right? Operating profit. So what are you supposed to do? DOVCO needs to be restated to cost of sales, meaning you change their GP. Now GP margins would change. Based on this, GP margins would change. Okay? Right. Notes to the financial statements show that COOCO paid its directors total salaries of 110,000, whereas DOVCO paid its directors total salaries of 560,000. COOCO has paid very low salary, DOVCO paid very high salary. How's the earnings? Equity return earnings 18,300 and DOVCO 2,600. Meaning they're not retaining company. They don't focus on growth. COOCO is taking less salaries. Maybe they're focusing on growth, right? So out of the operating expenses, 4,725, 560 of DOVCO is relevant to salaries, owner managed, right? Now COOCO 110. Now this, okay, this is owner managed, right? Now there could be a problem. COOCO might want to look attractive to buyers, potential buyers, right? So COOCO is trying to look more profitable, manipulating accounts, don't you think? Don't you think? 110,000 salaries, while 560, Cookco being a bigger company, since it's owner managed, now there is a potential of manipulation, right? What if Cookco is taking lower salaries to look more attractive, to make their profit higher and look more attractive to the buyers? So once they buy, things go wrong. Never know. Okay. So those are the information you need to grasp from the notes before you interpret or analyze. Right? Your interpretation needs to be of that depth. All right. Right. These costs amounted to 1.2 million for Cookco and 2.5 million for Doveco. That's a research expense, right? Cookco research expense 1.2, Doveco 2.5. Okay. Now there could be another issue here. Cookco's 1.2 million research and development. Doveco is paying more for research and development, meaning Doveco might potentially become a better company, right? Because they are spending more on research and development and they may end up becoming better company, while Cookco is limiting their spendings. Again, there's a spending issue here, right? They're trying to keep their expenses lower. Why? Yeah, maybe to look more attractive, right? Then they've given the ratios: GP margin, OP margin, return on capital employed. Those are three ratios, right? So when you're commenting on ratios, remember you start off with revenue. First, you look at the revenue and comment on that. Then you comment on GP margin, OP margin, ROC by considering the notes also. Now, OP margin is where that, the changes, or GP margin is where the research and development cost comes in. OP margin is where the salaries come in, right? So manipulation could be there, right? So comment on that as you proceed into each of the margins, right? Right. Now, looking at this, GP margin of Doveco is higher than Cookco. Doveco is making better GPs. Right? Let's restate and see. OP margin, Doveco is making lesser than Cookco, although the GP margin is much higher. Some problem, right? ROCE, Doveco has 8.3, Cookco has 18.8. Okay, fine. Now let's see how the adjustments would take place. You all know the formulas. GP margin, what's the formula? Gross profit divided by revenue. OP margin, operating profit divided by revenue into 100. Return on capital employed. ROCE, quickly tell me the formula. Should be knowing that. Return on capital employed. You're not supposed to Google it right now. You're not supposed to search it. Return on capital employed. Profit before interest and tax. Operating profit. Why? I had clearly told. When it's equity that's below, profit after tax comes above. Profit, if it's capital employed is equity plus long-term liabilities. Profit before interest and tax, or operating profit, in other words, will be the numerator. Denominator would be your capital employed. Okay, that's the formula. Right. So we have to first do the adjustments, and then we have to do the restatements. Right now, let's do the adjustments first. We've given the figures here. No? Right. What's the first adjustment? Revaluation model. 30 million of revaluation surplus. You have to eliminate that. Subsequent depreciation, you have to amend that as well. Okay. Now tell me, what would have been the depreciation otherwise? Remaining useful life 30 years, right? 30 years was a remaining useful life. So what would have been subsequent depreciation? What would have been subsequent depreciation? 30 million divided by 30, right? So 1 million would have been the subsequent depreciation. You need to eliminate that as well. You eliminate the 30 million, you eliminate the 1 million. Where do you eliminate 30 million from? You eliminate 30 million from revaluation surplus, right? You eliminate that from here. Okay. Equals minus this. Where else does this impact? Property value. Yeah. Property value also needs to go down, right? Why? Property value would have gone up. Minus 30. right? 30 million. But property value also would have been adjusted for subsequent depreciation as well, right? What's subsequent depreciation you need to add back? You have to add back how much? Add back 1 million. The subsequent depreciation. And where do the depreciation to operating expense? So where are you going to deduct that depreciation from? You're going to reduce the operating expense of Doveco, right? Doveco restatement. Co-adjusted figures. Right? Right. 4.725 is the expense. Now here you are going to eliminate, right? Reduce that by 1 million. Reduce that by 1 million. Okay. To insert one more line here. Right. That's the first adjustment. Yeah. First adjustment, we saw what happened. 30 million revaluation surplus removed. Why you need to move it to cost model? Revaluation surplus removed. You have to remove the NCA value. You have to eliminate the excess depreciation, subsequent depreciation. Okay. That's the adjustment number 1. Done. Right. Adjustment number 2, Cookco charges amortization. Right. Amortization of Doveco is how much? 2,500, right? So you have to eliminate from operating expense and you have to record it under cost of sales. So what are you going to do from operating expense? You need to remove, right? You eliminate from cost of sales. And you have to add to your, eliminate from operating expense and add to your cost of sales. Okay. Doveco adjustments. Adjusted figures. So I'm doing the answer here itself. I'm not using a separate tab for this one. Right. So what would be Doveco's operating profit? Oh, sorry, cost of sales, 10,850. Is there a change to revenue? No change to revenue. That remains as it is. So what becomes the GP now? 5450. From 7950, it went to 5450. Right. And then what's the operating expense now? How much is operating expense now? It's 1225. How much was it? 4725. Goes down to 1225. Right. And then finance cost. Right. You take the finance cost as it is. Right. But here you need to take a operating profit as well, right? They're not given the operating profit figure. Insert. What's the operating profit here? Equals 4225 is operating profit, right? Then there is finance cost of 200, profit before interest and profit after interest, right? Or profit before tax is going to be 4025. Then what's the income tax? Income tax also remains the same. Now your profit for the year becomes 3245. Now we have the adjusted figures. Okay. Let's quickly adjust this. What's going to be Doveco's property? 39,500. Equity remains the same. This becomes 0, right? Elimination, that makes it 0, right? Then the retained earnings. What happens to retained earnings? There's an adjustment that you have to do there, right? What's the adjustment? You have to add that restatement back, right? So you have to make the retained earning adjustment as well. There's a retained earning. Loan notes remains the same. There we go. Right. Now, while we are doing that, let's do a quick understanding of the interest. What's the interest rate? They have not given interest rate. Now, that's also going to be relevant to our interpretation. Okay. 200 is the finance charge divided by Okay, that's 3.8%. Right? Let me convert it to percentage. 3.85%. Right? So it's don't consider minus. The percentage is 3.85. And how much interest are they paying? Cookco. Doco's interest rate is lower. Cookco's interest rate is higher. Why is that? They're in the same industry, they're in the same industry. So you know this thing can't differ. Either it's going to be a related party transaction, right? Or it's going to be through a parent or a subsidiary, intra-company. That's where you receive the benefit, right? Otherwise, you won't have benefit. It's going to be equal. That's also a problem. We need to try to touch upon that aspect to figure out why finance cost, because you see the finance cost is very low, right, of Dovco, right, compared to Cookco, while the loan notes figures are almost similar. Let's touch upon that. Right. Then what happens to the restated Dovco ratios? Right. Now let's quickly restate updated GP. How much is that? This divided by revenue. Okay. Updated OP, operating profit, is this divided by this. That's the updated operating profit. Then ROCE, profit before interest and tax, operating profit in other words, divided by what's the total equity? Okay, this plus this plus the liability. Okay. Right, so let's quickly convert these to percentages. Right now you see, oh my God. Now it's more comparable. Now GP margin becomes of Cookco, Dovco comes down and it's more comparable to Cookco now, right? OP margin, now it's a reversal, meaning Dovco is performing better in terms of OP margin than Cookco. Well, initially it was different. So this shows how choices of policies, accounting policies also can impact the financial statement figures. Why? What did you do? We just adjusted the policies, right? So how that's going to impact is also key. And then just look at the ROC. It jumped all the way to 43.11%, right? From 8.3%. Okay, now that is unrealistic. We have to figure out, try to understand what that is. Requirement A is complete, right? Requirement A, how do you complete? What was the requirement A? These adjustments, right? We adjusted the financial statements. That's how we arrived at requirement A. Now comes requirement B. Based on these adjusted accounting ratios, compare the performance of the two companies. Your answer should comment on the difficulties of making a purchase decision based solely on the extract of the financial statements, right? Should comment on the difficulties of making a purchase, right? Meaning this is going to be inconclusive. You can't conclude which one to purchase, right? Because there are difficulties, is what they are indicating here, right? So when you interpret, right, when you start interpreting, remember that you don't assume, right? Don't try to come up with your own figures. Don't try to think, okay, what if? Whatever the figures are given, make your thoughts based on those figures. If you see that those figures are insufficient to make a decision, you mention that the information provided is insufficient, which is why conclusion cannot be reached. Okay. So let me quickly give you an outline how you can face an interpretation question. Okay. So always start by commenting on revenue. Okay. So what happens with the revenue? Yeah. Yeah, that's what I'm saying. You had first, that's why you interpret your revenue, how the revenue difference, how the revenue changes, etc. Then you come in, now you already calculated the ratios. No, now you interpret based on the ratios and the given information. Okay. GP margin is the next that you interpret. OP margin is the next that you interpret. and ROCE is the next interpretation point that you're going to focus on. Yeah, very much. Not that 4, right? Now, you saw the depth I went into. Salaries, right? There was research and development expense, policy changes. You can touch upon all those aspects, right? You can touch upon all those aspects, right? Now, only when you touch upon those elements, you will be able to give a thoughtful interpretation, right? Which will show that you are, well in control, right? You know what you're doing. You know what you're interpreting. You know the numbers. You know what the ratios mean, right? What goes into the ratio, right? Now see, ROC. What could be the reason why ROC? Now, Dove goes GP margin, we know it would be the cost of sales or revenue that's going to impact GP margin. So cost of sales changed. When we change the policy, the cost of sales changed, right? Which is why that has happened. That's the case, right? Based on that, you can touch upon the research and development expenses. Maybe Doveco can become a potentially a better company because they are investing in the research and development. While Cookco, they are not focusing on much research and development costs. So maybe they might not be able to keep up with the evolving changes in the industry. Okay. Then you can touch upon the OP margin. What may change the OP margin? The operating expenses, right? So what could be the parts of operating expenses, right? What were the parts of operating expenses? Touch upon that. Depreciation is a part of operating expense. Again, when you change the policy, right? You moved from operating expense, the research and development, to your cost of sales. That changed the operating expenses, right? So operating profit margin changed. Now, OP, based on OP margin, you know that it's Doveco that looks attractive. Even from GP margin, Doveco looks attractive. Not always. If revenue increases and cost also increases, proportionately GP margin won't. Then GP margin should increase. Yeah. All right. So I would recommend you to watch my interpretation live class recording as well. You were there, no? So we went into the depths of how GP margin works, how OP margin works, how revenue changes impact, how cost of sales changes impact, right? Right. Okay, now when we look at the financial figures, what else can we see here? Doveco's property value is 39,500, right? While it was 68,500, now it's 39,500. While Cookco's property is 22,250. Okay. Then retained earnings, Cookco is having more retained earnings. Doveco is having lesser retained earnings. When you eliminated the revaluation surplus, the entire, what's the formula for ROCE? Operating profit divided by equity plus long-term capital, right? Now, when you eliminated the revaluation surplus, what happened? Suddenly your equity figure went down. So your denominator reduced. So very unrealistic, right? Because they are taking high salary, they're not focusing on growth. Doveco is not focusing on growth, but they are investing in the research and development. So maybe they are focusing on potential growth, right? But inconclusive, we don't have sufficient information to comment on those, right? But we can touch upon those and we can tell that it's inconclusive. We need information. Okay. Right. So difficulty in analyzing can be because that they have not even given the investment number to purchase. How much cost? How much is Doveco going to cost when purchasing? Now that is also difficulty. When you're touching upon difficulty, you have to touch upon those aspects, right? Operating profit, it's not clear why Cookco is charging lesser salaries while Doveco is charging. That's also not clear, right? Finance, again, a difficulty is the finance cost, right? The percentage, the interest rate that Doveco is paying is much lower than what Cookco is paying. So what could be the market rate? That information is not given, right? So those are some of the difficulties that you face in interpreting, right? What are they saying? They are asking you to touch upon, comment on difficulty. So these could be certain items that you can comment based on the difficulties you've come across. And accounting policies, you can even touch upon accounting policies. When the accounting policies are different, that also can cause difficulties, right? What now, they've given only 2 accounting policies. What if there are other accounting policy changes? We don't know, right? So insufficient information, right? So that you will have to show. But you can, what you can clearly tell, interpret, or what you can clearly conclude is that both the companies are profitable and both are performing well. 32, because both the ratios are good, right? 32.30, 33.44, 23.30, 25.92, 18.8, 43.11, not bad, right? Both are performing well, right? But you will need previous year's financial statements to comment more on this, right? Now, only 2 companies, 1 year is not going to help you. Had they given you, now you can ask that, had we been given, or if we have access to the information of last year of these 2 companies, we can make more practical comparison and practical recommendation. We can see whether last year's salary also was same amount or not. Then we can comment on those difficulties also, whether last year's finance cost was same or not, right? So we need at least 1 year to compare, right? Therefore, always remember, when it is conclusive, conclude. When it's not conclusive, you can tell it's not conclusive because these reasons. Nevertheless, both the companies are appearing profitable. We will be needing more information to comment on the conclusive possibility of which company would be a better fit to make the purchases. Is that clear? Is that clear, guys? Guys online, is that clear? So that should be your thought pattern, meaning touch upon all the figures that are given here, right? Touch upon revenue, cost of sales, GP margin, OP margin, touch upon the finance cost element, right? Then you, then sometimes how does the comparison work? Either you have to compare with the last year's same company's last year performance, or you have to compare with the competitor, or you have to compare with sector average, right? But when it's a competitor or sector average, you can't conclude always if the past data is not available. Like in this case, right? 2 competitors is what there. That is easier, right? But again, nothing is hard and fast though. It's all the technique that you use. Let's quickly have a look at how the income tax percentage has been as well. So we can actually comment on that too. I have to comment on all of these figures. 25%, 30%, despite being in the same industry. Why is that? Maybe it could be because of the income changes. Look at all these figures: finance cost, income tax figure, right? Then how the equity component and liability, long-term liability component changes the ROCE, right? That's what you comment on when you look at ROCE. Then you know that both the companies are owned and managed, meaning there is more room for potential manipulation. Have they done the manipulation or not? We see the salaries could be a manipulation, but we can't comment on that. We can't conclude. So we need more information, meaning a past year's data would help us evaluate better, right? Then you can touch upon the policy changes, right? Then you can touch upon the research and development expenses, Cook being lower, Dove being higher. Then you can talk about the other aspects that you think would be affecting these ratios. Then difficulties is something that they're asking you to touch upon. So you fulfill those requirements as well. And that is how you interpret. Okay. Now, interpretation is going to be subjective. Each of you is going to interpret differently. So you all are going to get marks for well explained, well understood, and a practical interpretation, rather than just it being a generic or a vague interpretation. Always make sure your interpretation should be case specific, scenario specific. You take points from the scenario and you discuss on that. You don't just take ROC and explain, okay, what does ROC mean? This is what ROC is, definition, this was the formula. No, that's not going to get you marks. What is the problem here? In this scenario, what is it? So scenario based. Your interpretation needs to be scenario based. Okay, is that clear, guys? Is that clear? Is that clear? Right. Super. So we are well on time, as I told you. I mean, we are ahead of time rather. We can take a 15 minutes break and still we'll have 1 hour. I thought 45 minutes, but we'll have 1 hour for the section 8 questions, right? So let's take a break of 15 minutes. So Azma, there is not a generic statement per se, but what I used to do is 1 point for 1 mark. 10 points, I mean 10 mark, 10 points, but here you have to split them accordingly, right? GP margin, OP margin, ROC, look at which is heavier, which has more information, then conclusion. No, it's paragraph. And don't give points. Bullet points is a bad idea for interpretation. It needs to be a full explained sentence, a full explained paragraphs. Each point should be a well explained paragraph. Yeah. Revenue, GP margin, OP margin, ROCE, difficulties, conclusion. Break it to those and then explain, right? Well explained paragraphs need to be given, right? Okay. All right, guys. So now let's take a 15 minutes break and come back and start the section A discussion. Okay. No, Azmat, it all depends on how well explained. I mean, you can't be vague and you can't just go on explaining things without it making sense. So it needs to make sense and it needs to be relevant. Okay. Right. Okay, guys. So come back in 15 minutes. Huh? All right, guys, shall we start? Are you ready for a quick back-to-back question discussions of section A? Again, we are going to touch upon the questions that many found challenging, many students have found challenging. These are all past paper questions, right? We have done some of these questions in the first session where we discussed Power 50 questions, right? I mean, not exactly these questions, but these types of questions have been discussed, have been touched upon in a Power 50. But I wanted to touch upon these questions that are directly from a past paper and that many students have found challenging to respond to. All right. Okay, so the first question says, on 1st of January, please, can you confirm you can hear me? Quickly confirm my audibility first. Quickly confirm the audibility. Guys online, Azmat, Amani, can you confirm you can hear me? Quickly confirm so that we can. All right, thanks for confirming, Amani. Right. The first question says, on 1st of January, 20x5, Factman Co. acquired a piece of equipment at a cost of 25 million. Right. The equipment has a useful life of 5 years. Right. It has a useful life of 5 years. And the company must decommission the equipment at the end of the 5-year period. The estimated cost of this decommissioning in 5 years' time is 10 million. Factman Co's cost of capital is 10% per annum. The present value of $1 receivable in 5 years' time at a discount rate of 10% per annum is 0.621. Factman Co has correctly capitalized the equipment and recognized the provision for decommissioning costs at the correct amount. Right. Now, since they have correctly capitalized, they have correctly recorded the provision, what is the total charge to P&L relating to the equipment and decommissioning provision? Right, so what are charges? Decommissioning cost, IAS 16, we have looked at it there. What's going to be relevant to your P&L? Anything that's capitalized will be depreciated. And anything that is brought into present value will be unwound. So there is unwinding cost there. Okay. This I'm doing, it's not a question. You will not be able to access these questions. Right. So yeah, it's just a discussion. So you all are going to look at these questions and get some ideas. Rewatch this and you will be able to understand things better. All right. These are section A questions, right? Section A questions, and these questions are the questions that the students have found challenging. Now, if you ask me, how did I find these questions, right? That's a secret. I'll tell you all later. Okay. So if you're actually looking at, if you're actually doing what I've asked you all to do in the planner, y'all definitely will understand where these questions come from. Now, this would show how many of you all are actually following the plan and how many of you all are not. All right. Okay. And I'm assuming that some of you might not be, which is why I've brought the questions here itself. Right. Okay. So when it comes to the P&L, you are going to have depreciation, which is the capitalized amount. And then you are going to have the unwinding cost, the cost that needs to be unwound, the provision, right? For FAB, the present value of future cash flows. All right. So how are you going to do that? How are you going to do that? Let's go back. So we are going back and forth here, right? So cost of 25 million. 25 million is the cost. Then if you all remember IA 16, right? You all would know the decommission cost, the present value, will be capitalized. So what would be the present value here? So decommissioning cost is 10 million. So what's going to be the present value? 10 million into 0.621. 10 million into 0.621. How much is that going to be? 6.251. Yeah, approximately 6.251. Right? Okay, I want you all to use a calculator, please. 0.621, 10 million. Not 6.251, it's 6.210. All right. Please use a calculator. 6.210. Okay. So what's the total capitalization? 25 plus 6.210. 30. 1.210. Okay, that's what's being capitalized, is it? That's what's being capitalized. Right. So what is going to be the depreciation? What's the useful life given here? 5 years divided by 5. Quickly tell me what is the answer? 31.210 divided by 5. $6.242. That's the depreciation aspect. Right. What's the second aspect here? Unwinding cost, right? So what was the value? 6.210 is the present value. 6,210 into 10%. What is going to be the 621? So what does it become? 0.621, right? Right, 0.621. So what's the total? 6.863. So what would be your answer here? To the nearest thousands, you will have to 6863. Bring 6863. Now, why students found this challenging? As I already know, Asmat, not SBR. These are not SBR questions. These are FR questions, very much FR questions. At this point, I'm not going to discuss SBR questions because I want you all to pass FR exams, right? Then we go back to the SBR questions, right? To do more challenging questions. These are very much your past papers of FR, which is not available, widely available, but it's available somewhere. I'm not going to reveal where it is because I've already given that in my planner, right? Okay. So why students found this question particularly challenging was because some of them missed to capitalize, right? The decommissioning cost. Why? Because IA 16 was not strong, right? Some of them just took the unwinding cost, right? And they showed that as a profit and loss. Yes, that is a part of the charge, but depreciation also needs to be there, right? So some of the candidates who did the depreciation did it without the capitalizing of their value. They did it for the actual 25 million divided by 5. Okay, so those were the areas how they went wrong, right? So remember, whenever they ask you to show what is going to be the charge in profit or loss, you need to be showing all the charges that are relevant to profit or loss. Okay, is that clear? Is that clear? Yeah, right. Next question. Sagan Co. acquired a brand name with an estimated useful life of 10 years on 1st of January 2022 for 10 million. On 1st of January 2025, a brand specialist believed the brand to have a fair value of $14 million. Sagan Co. also ran a training course on 1st of January 2025 for all staff on how to use a new software system. This training costs Sagan Co. $450,000. On average, the employees are expected to remain with Sagan Co. for 3 years. Right. How much should be recognized as an expense in the statement of profit or loss for the year ended 31st December in respect of brand amortization and in respect of training costs? What do you think? What do you think? Will you be considering 14 million the fair value or the 10 million? Why? Hmm? Acquire a brand name. It's a brand, acquired brand. Ten or 14? So they asked me 31st December 2025. Subsequent. Why 10 million? Tell me. You can't just say 10 million. You'll have to have a reason to tell 12 million. So Azmat, Kaplan, as I told you, takes some questions from the past papers, right? So these are not, some could be in Kaplan, but they are not Kaplan questions. They are past paper questions. Yeah, now you don't break your head thinking where I have given you all, right? Now that's for you all to do as a homework, right? So for the moment, just look at the question and try to understand what we are doing here. Right, 10 or 14, quickly tell me. IAS 38. Why 10? Internally generated brand. This is not internally generated. This is not internally generated.
Yeah, but they
What is internally generated? What is acquired? You need to clear that out. IAS 38. IAS 38 says you can use revaluation model for intangible assets only if there is an active market for it. Brand is going to be distinct. They are going to be different. There is not going to be an active market, which is why IAS 38 specifically disallows revaluing brands. It is an acquired intangible asset. It's not internally generated, right? But still, no, acquired remains acquired forever. Yeah.
They can't increase it.
Why not? Whatever is acquired can be sold as well, right? Internally generated can be goodwill. Internally generated can be a brand, not a brand name, a brand, right? And Apple is an internally generated brand. If Apple acquires Samsung, Samsung will remain an acquired brand. Yeah, Apple can even sell off Samsung in a future date, right? But brand cannot be revalued specifically. Why? Because there is not going to be an active market. Only if there's active market, you can revalue. There's no active market, you cannot revalue, and brand specifically is disallowed because of that reason. Okay. No, why? Why? You should know why, right? So 10 million is what you're taking. Divide by 10. So brand amortization is going to be 1 million. How come? 10 million divided by 10. Training cost? Or you divide by 3. Expense incurred, you need to record. Okay. Although it is going to generate future benefits, you have no control over these employees, right? That you're training. Yes, those are expenses, you incur it as it is. Right. Next question. Which two of the following statements are true regarding the conceptual framework for financial reporting of the International Accounting Standards Board? A, it is principles based rather than rules based, but it is not an IFRS standard. B, the principles contained in the conceptual framework overrides any IFRS standard that exists. C, it requires accountants to evaluate and address threats to compliance with fundamental ethical principles. D, if it is revised, it will not automatically lead to changes to the IFRS standards. What are the correct options? What do you all think are the correct options? A is correct. Correct. That's correct. What's the other one? Amani says A and C. Umar, A and C. Azmat? There is no ethical principles or ethical threats mentioned in conceptual framework. Where do you have that? Conceptual framework has 8 chapters, right? What are those 8 chapters? It shows the elements, it shows the underlying reason, it shows the financial statements, right? Where do they talk about ethical principles or threats? It's not conceptual framework, right? Remember, conceptual framework has been revised, right? Conceptual framework has been revised. But unless an IFRS, now you see IAS 37 provision, still that defines assets, liabilities based on the past conceptual framework, right? The old one, not the updated one. But the updated, the revised conceptual framework did not override IAS 37, right? IAS 37 standard will have to come up with their own amendment to that standard, right? Meaning, if conceptual framework is revised, it cannot lead to changes in IFRS automatically. IFRS standard overrides conceptual framework. Yeah. IFRS standard requirements overrides conceptual framework. Okay. A and D. Okay. Many found this challenging. Why? Because they are very confusing options. Okay. Most of students went with A and C. If it is revised, it's not going to automatically change IFRS standard, right? Conceptual framework change is not going to override the IFRS, but IFRS overrides conceptual framework. Okay. Right. The next question. Pearlco has controlled an 80% owned subsidiary, Silverco, for many years. Silverco sold goods to Pearlco for $120,000 at a markup of 20% during the year. Pearlco has sold half of these goods by the year end. Which are following statements regarding intra-group transaction in the consolidated financial statements are true or false? Right. Revenue must be reduced by a total of 120,000. Is that correct? That's correct. Yes, straightforward. Cost of sales must be reduced by a total of 110,000. Calculate, yeah. 120, anyway, you're reducing, no? But there's an unrealized profit component that's going to be there. What's the unrealized profit? 120,000 is a markup. So 120,000 divided by 120 into 100 is your cost of sales. 100,000 is cost of sales. 20,000 is your profit. So when 20,000 is your profit, half of these goods are remaining. So 10,000 remains. So 120,000 plus 10,000 is 110,000. Minus 120 plus 110. That's correct. True. Non-controlling interest must be reduced by 2,000. Silverco has sold to Pearlco. Pearlco is a parent, Silverco is a subsidiary. So when subsidiary sells to parent, it impacts NCI. So 10,000 remains, NCI is 20%, so this is correct. Okay. Right. Next question. Saguaro Co. acquired 25% of the equity shares in Cactus Co. for $400,000 on 1st of March 20x1. In July 20x1, Cactus Co. paid a dividend of 36,000. Cactus Co.'s profit for the year ended 31st December was 115,000. All profits accrued evenly over the year. Right, now this is an associate. Okay. What is the carrying amount of investment in the associate as at the year end? What was the investment value? 400,000. Right. And then when was it purchased? 1st of March, right? Right. 31st December. How many months was it owned? March, 10 months. Yeah. So what's the profit? 30% into 10 months profit. How much is that? How much is the total profit? Total profit is 115, 200. So you have to do 115, 200 into 10 over 12 into 30%. How much is that? Quickly do the math. Quickly do the math. 200 into 10 divided by 12 into 30%. Quick. 28,800. Right. Then there is a dividend, right? You have to eliminate dividend. Associate dividend is eliminated. How much is the dividend? 36,000. 30% into 36,000. How much is that? How much is that? 36,000, 30%. Use the calculator. You have a calculator to do that. 10,800. What's the answer? 400 plus 28,800 minus 10,800. What's the answer? Is it 10,800? Are you sure? 36,000 divided by 30% into 30%. Yeah, okay. What's the answer? 400 plus 28,800 minus 10,800. No. There's some calculation error you have made. You have made some calculation.
400 plus 2800 minus 10,800. Is that what it is?
What's the error we have made here? What's the error we have made? What have we taken it as? Now do the adjustments. 25%. Be very careful to read the question scenario completely. 115, 200 into 10 over 12 divided into 25%. How much is that? Hmm? 24,000. Right. 24,000. 25% of 36,000. How much is that? 6. Calculate. It's 20% is 6,200. How much? 9,000. What's the total? 424 minus 9,000 is 415,000. Correct? So that's going to be your answer. Always remember to read the question completely. All right. Okay. That's what. You also did not read the question properly. Right? Okay. Theoco acquired new plant on 1st of January 2023 for $6 million. It was partly funded by the receipt of a $2 million government grant on the same date. The plant has a useful life of 10 years. Theoco is unsure whether to deduct the grant to calculate the carrying amount of the plant or to use the deferred income method. Based on different ways to account for government grants, which two of the following options can be recognized in the statement of financial position? Meaning you have to do both the ways, right? You have to do the calculation both the ways. Okay. So what does it require? It requires you to have a strong standard understanding. Okay. How many of you all have the strong standard understanding? You need to have that. Do you know how to do this question? Tell me what's the first way? Method 1. Deduct from NCA. Right? What's the first way? 6 million new plant, 2 million grant. 6 million minus 2 million. That gives you 4 million divided by how many years? Useful life of 10 years. Right? Useful life of 10 years. How much is that? 4 100. What's 400? 400 is the depreciation, right? 400 is the depreciation. Okay. So what are the options given? Non-current liability option, non-current liability, non-current asset, non-current asset, right? Two of the following. Okay, now there is 400 depreciation. What's the plant value? 4 million minus 400 is 3,600. Which of this is correct? The one way? D is correct, right? Okay, D is correct. Okay, right. Second way. What happens in second way? Second way, deferred income method. Method 2, deferred income. Right? How much was the grant? 2 million. Divide by 10. How much per year? 200. 1 year gone, right? So how much is the total grant? How much deferred income remaining? 1.8 million. What are the options given? Non-current liability of 1.8, non-current liability of 1.6. Yeah. So tell me, non-current liability of 1.8 or non-current liability of 1.6? What's correct? 1.6. Why? Because 200 out of this is current. If they ask you total liability, then 1.8. Non-current liability is 1.6. B and D. Understood? What's the standard? IAS. What's the standard? Huh? 20 government grants.
So it's 40 is
Property, investment properties, IAS 40. Okay. Right. Baloko owns the property which it rents to third parties. Okay, now this is IAS 40, right? According to IAS 40. Right? It acquired the property on 1st of January 2025 for 10 million. At 31st December, the fair value is estimated to be 10.6 million, with expected selling cost of 0.2 million. The property had an estimated useful life of 40 years. Baloko used the fair value model to measure the carrying amount of the property. What's the gain to be recorded? Quickly tell me. IAS 40. IAS 40 gain goes to other comprehensive income, profit or loss? Profit or loss. Let's select that first. Easy option. Right. What's the gain? 400. Why?
selling.
Yeah.
No, sir. Oh, 600 is the gain.
Hmm?
The depreciation calculation.
What's the depreciation calculation? Azma, tell me depreciation calculation. You also mentioned about that. What's the depreciation amount? Hmm? 650 the depreciation. Gain is 650. Depreciation of 250. Very good. Azmat, you tell me. How much is the depreciation here? How much is the depreciation, Azmat? Azmat got it. Right? IAS 40. No depreciation. Fair value every year. So what's going to be the gain? Don't get confused between IAS 6 and IAS 40. Okay, I had clearly on the first session, I had mentioned about this also. In the study plan also I've mentioned, right? Special focus on IAS 6 and IAS 40. That was the day one. I forgot what you all did on day one. Very good. 600,000, 10.6 minus 10. That's the gain. No depreciation. And it's every year annual fair value adjustment and the gain. It goes to profit or loss. Impairment. Oh, so that's a revaluation loss, revaluation gain, revaluation loss. Okay. Right. The next question. The next question says, a company commenced work on the construction of a significant asset for one of its customers on 1st of May 2025. Construction is scheduled to run for 2 years and the total contract price is 5 million. At 31st December 2025, the following details are obtained in relation to the contract. The percentage complete was 50%. Amounts invoiced to the customer totaled 1.7 million. Amounts received from the customer totaled 0.8 million. What is the total amount that should be included in the statement of financial position as of 31st December 2025 as a contract asset or contract liability? What's the standard? What's the standard? Quickly tell me the standard. What's the standard? Very good. Very good. Right. How to identify contract asset or contract liability? Okay, y'all do this question. Give me the answer first. Then I'll explain to you all what the answer is. Calculate whether it's a contract asset or contract liability. 800 contract asset. 800 contract asset. Okay, that's Amani's answer. What's your answer, Umar? Azmat, what's your answer? Do you recall how to calculate contract asset, contract liability? How do you calculate that? 5 million is the contract price, right? But how much is complete? 50%. So 500 is supposed to be the revenue recognized. How much you've invoiced? What's the difference? How much you have not invoiced but revenue recognized? 800, right? That's a contract asset. Amani is very good. Very good, Amani. Right. So 800 contract asset. 800,000. Clear? Do you recall that, Umar?
Yes.
Need to revise. Very good. You told you only have to revise IAS 37. I have to revise this also. It's supposed to do that. Right. Okay. No worries. Still you'll have time to go through it. So don't get discouraged. Okay. Right. The next question. The next question says, for several years, Jaswinder Co. has applied the cost model to its investment properties. From 1st of April, the fair value model was applied to investment properties as fair values were greater than carrying amounts across all investment properties. A fair value gain of 30 million was recognized in the financial statement. There's been no change in the useful life of investment properties. What effect will this change in accounting policy have on the financial statements for the year ended 31st March 2024? Tell me. Tell me what's the answer. Both OP margin and gearing will increase. B, other component income will increase and gearing will decrease. C, profit before tax will increase and gearing will decrease. D, profit before tax will not change and gearing will increase. C, why C?
Because of things income. Before tax increases.
So operating profit margin also increases, right? When the
After operating.
what comes after operating profit? Depreciation. Investment income is depreciation, right? Azmat says other component income will increase and gearing will decrease. Fair value, IAS 40, fair value, we just saw it's recorded into a profit or loss, not other component income, Azmat. OP margin will increase or not? depreciation will reduce, meaning it will increase your operating profit, right? When your operating profit increases, meaning your operating profit margin goes up. But what's the catch here? Who told? Use the calculator. Do a 400,000 over 1 million and do a 600,000 over 1 million. Right, understood, Azmat. If that is so, all right. If that was not the case, you have to revise. Umar, do a 400 over 1 million. Increases, right? Operating profit margin. Then, why can't it be A and why is it C? How was the gearing formula? What's the gearing formula? I'm being really critical right now. Tell me quickly, tell me what's the gearing formula? How many weeks more to go to the exam? 2 months? 3 months? 1 month? It's just little more than 1 week, no? Debt over equity, okay, that's one. There's another formula, debt over debt plus equity, right? Debt over equity or debt over debt plus equity. Why you need to have this all memorized in your head, in your mind. You can't be thinking, you can't be, looking here and there. You can't be looking on the, concrete. Concrete will not give you an answer. Okay, right.
Excuse me,
So
sir.
what happens now?
Excuse
Debt.
me.
Yes.
Sir, I had an issue in a ratio interpretation question where I used the debt over equity plus debt ratio, but then
Okay.
the question used the other one. But they weren't specific on which one to use.
Always, if there's an option to use both, if it's a writing, explanation, interpretation question, use both.
Use
If
both, yeah.
not, gearing, it needs to be question based. What are they asking? Are they asking you to just focus on equity, or are they wanting you to focus on both, capital employed, debt plus equity, right? So you need to respond based on the question requirement, okay? But if it's an interpretation question, do it in the both ways. Right? Because both are correct. Clear?
Yes.
Azmat, tell me, Umar, tell me, debt over debt plus equity, right? Now what happens? Operating profit increases, meaning your equity increases or not? Yeah, retained earnings increases, meaning your equity increases. Your debt remains the same. Same. This increases. If this increases, what happens? Gearing is going to decrease. A is incorrect because they are saying gearing will increase. C is correct. Your answer is correct. But you should be knowing to explain why your answer is correct. You can't be, you can do guesswork, educated, but educated guesses is what is important. Okay. Your answer was correct, but it was just an abrupt answer you gave. It's a C. But why C? You're not sure. You got confused, right? Clear? Yeah, that's what. So gearing, you need to be clear. Okay, profit impacts retained earnings, impacts equity. Equity changes. That does not change. So always when such questions, guys, remember, if you are stuck in such a question, now here there is no number. That's why you're stuck now. So always try to bring in number, right? Always bring in a number and try to figure out with the number. Had you put a number now, as I told you, if you put debt, give a number to debt, to give a number to equity, then you increase your equity number, then you will be able to figure out, okay, whether it's increased or not. Right? So such questions, please come up with your own figures and try to figure out. Okay? Right. Okay. Next question. Kajekko manufactures canoes and kayaks for the European market. It is consistently a highly profitable company. This trend is expected to continue. Most revenue is earned during the Northern Hemisphere's warmer months of March to August. All sales are on credit terms of 30 days. Upon incorporation, Kajak Co. chose between an annual reporting date of 31st January and 31st August, selecting the 31st January. Okay. Which two of the following would be true if Kajak Co. had instead chosen a reporting date of 31st August? Right? What would have been true? A. The statement of financial position as of 31st August would show Kajak Co. at its most liquid. B. The time and cost of counting inventory should be minimized at or near 31st August compared to 31st January. C. Profits for the year ended 31st August would be higher than it would for 31st January. D. Net cash generated from operations would be higher for the year ended 31st August than it would for 31st January. Now remember, in such scenarios, if you all feel confused, if you all feel lost, if you all are trying to figure out, okay, what could be right, and you don't understand, now this question you might be not understanding, okay, what is right. So here you use elimination method. What does not work? Let me eliminate that. That would help you. Okay, in case the correct answer, when you look at the options, you feel, boggled, always do use the elimination method. What does not work, remove that. Okay, right. Quickly tell me which two of the following is true if the reporting date changed. Most revenue is earned during March to August. Tell me. Tough question. So because these are the questions where actually students got stuck. These are all actual exam-based questions. Huh? Right. Let's try to break it down and understand. First one says statement of financial position as of 31st August would show Kajak Co. It's most liquid. How do you see whether it's liquid or not? Liquidity ratios, current asset over current liabilities, right? Now, why are I saying most revenue is earned during the Northern Hemisphere's warmer months, March to August, meaning there is an inventory movement, consistent inventory movement, consistent sales are happening, right? So current, even when sales are happening, your receivables will be higher, right? So you're liquid at your most liquid, don't you think? When closer to August, you're at your most liquid, correct? B, the time and cost of counting inventory should be minimized at or near 31st August compared to 31st January. There'll be limited inventories, right? Because inventories are moving fast. So inventories are going to be less. So you will have to spend less time on counting inventories, right? Because you'll have very limited inventories at that point. Right? So A and B is the answer. But had we worked on elimination method, if this was not clear, C, profits for the year ended 31st August would be higher than it would for 31st January. Both are covering 1 year. Even 31st January would have that warmer, highest profit period. Even 31st August also going to have that highest profit period. There's not going to be a difference there. Net cash generated from operations would be higher for the year ended 31st August than it would for 31st January. Again, it's going to be for an entire year, right? Net cash generation also, cash flow statements also for an entire year. So when you take for an entire year, anyway, a year is going to have those liquid period. Okay. So you eliminate those two. Clear? Right. So A and B is the answer. So remember, there could be such questions in your exams. Don't get disheartened. When you look at such a question, you feel boggled and you feel lost and you feel like crying and going away from the exam, right? Don't do that. If you find it difficult to find the correct answer, use the elimination method. Even if you find the elimination method difficult, do an educated guess. Okay? An educated guess. Right? Not a tactic to guess. It should be an educated guess. Okay? Right? So you break it down and try to understand, okay, what is this saying? Now, when I explained, it was clear, right, what A and B mean. So try to break it down. Right? That's what is important. Right. Next question. Bubber Co. acquired 60% of Randit Co. on 1st of April 2026. On that date, the carrying amount of Randit Co.'s net assets equal the fair value except for property. Randit Co.'s property with a carrying amount of 1.8 million had a fair value of 3.2 million and remaining useful life of 50 years. This is the only property within the Bubber Group. What is the impact of the fair value adjustment on the Bubber Group's consolidated retained earnings? Okay, what are the workings this is going to impact? Working 2, which is net assets. What else? From working 2, what does working 2 impact? Working 4 NCI and working 5 retained earnings. Correct? Right. So what's the fair value adjustment? 3.2 minus 1.8. How much is that? Quickly tell me. 3.2 minus 1.8. 1.4, right? Yeah, 1.4. How many years? It's 50 years. How much is that? 1,400 divided by 50? 1,400? 28,000. That's going to be here, right? What are they asking? Group's consolidated retained earnings, working 5 figure. Now 28 is also there. You could have selected that. Yeah. But what are you supposed to select? 80%. Right? What's the percentage? 60%. Sorry, not 80%, 60%. This retained earnings will have 60% of working 2. That is 28,000 into 60%. How much is that? Post acquisitions. That's 16,800. 28,000 also was there, right? You could have selected 20,000. Be happy. I did my question. I had the answer. I'm very happy about it. But what you missed? They are asking working 5, not working 2. Had they asked working 2 net assets figures, 28,000 words. Otherwise, you have to give parent percentage. Clear? Right. The next question. On 1st of January 2026, Causeway Co. acquired property through a 7-year lease. 7-year lease. The following information is relevant. On 1st of January, an initial lease payment of 6 million was made. Annual lease payments of 12 million are due 31st December. Is it a payment in arrears or advance? IFRS 16. Is it arrears or advance? Arrears. Why? Year end. Okay. The rate of interest implicit in the lease is 5%. The present value of lease payments on 1st of January before the initial lease payment was 75 million. Right. What will be the finance cost in respect of this lease in Causeway Co. statement of profit or loss for the year ended 31st December 2027 to the nearest dollar? Right. Now for this, what you have to do, you have to create a lease table, right? They are asking for December 2027. 2026 is the year. Okay. Now you'll be using a lease table. Here, there is X6, X7. There is opening liability. Liability. How much will you take as opening liability? 75 million. 75 minus initial payment. 75 minus initial payment of how much? Initial payment was 6 million. 75 minus 6, that's 69. That's going to be opening liability. Now, interest, what's the interest rate? What's the interest rate? Interest rate is 5%, right? 5% of what? 75 million. 69 million. What is the 5% of 69 million? How much? 3,450. So what's the closing liability here? This will become the opening liability. This we could have done in Excel, but I am doing it here so that we don't have to go back and forth. Closing liability, what would it have been? 69 plus 3,450 minus 12,000. How much is that? 6,450. Very good. Now that will go as the opening liability of next year. 6450 into 5%, how much is that? 6450 into 5%, how much is that? How much is that? 3022.5. Right? So this is going to be your answer. You can do beyond this, but the answer is 3022,500. Right? 3022,500. So nearest thousands. Okay, that's the answer. Right. Next question. At 31st March 2023, Algernon Co. had equipment in its inventories which was manufactured to a customer's specific requirements and had originally cost 380,000. The selling price has been agreed as 420,000, but new regulations mean that safety measures must be added at a cost of 60,000 before the equipment may be sold. The customer has agreed to pay for half of these modification costs through an increase in the overall selling price. In accordance with IS2 inventories, what is the value of these inventories to be presented? What does IS2 say? Lower of cost or net realizable value. Okay, what is the cost? 380. What's the net realizable value? 420 plus how much? 60,000. 60,000 into 50%. Half of that, the increase in selling price. So now selling price becomes how much? 450, right? 450 minus the cost. How much is that? 390. What is lower? Cost to NRV. Cost. What's the answer? That's why customer is bearing half of the expense. Our customer allows to increase the cost also. It's partial, half. Okay. Had you selected full, you would have answered for that also. Right. So be very careful. Right. Now this IAS 41. So we have touched upon a lot of standards, no? IAS 41. Now this I want you all to attempt this question. Scotswood Co. purchased a herd of 600 bison on 1st of February 20x5 and correctly recognized this transaction at $90,000. At 30th June 20x5, the year-end date, the market price for a similar size of herd was $175 per bison. All trading of bison incurs costs of 8% plus an additional fixed charge of $1 per bison. In accordance with IS 41, agriculture, what is the carrying amount? So you need to be particular about IAS 41. You need to know IAS 41 standard. Quickly tell me, do this question. Attempt this question. Attempt this question. Tell me what's the answer. So we have 6 more questions. So we'll discuss all these 6 questions and conclude, okay?
This 6, so
Without this 6. I know discussion is quicker, but some things I have to let you all, because these are standards I know that you all don't focus much on. And then when you have a question from the standard, you get stuck in the exam. No? Very good, Amani. Section A. So you're going to make tactic to such questions. What does the IAS 41 say? What does IAS 41 say? How are we going to value the agricultural properties? Fair value less cost to sell, right? Now, cost to sell, what are you going to consider as cost to sell? What are you going to consider as cost to sell? Cost to sell is $1, right? Fair value is where you take the 8%, right? You reduce your fair discount, 8% discount. Okay. So how are you going to do that? 600 bisons into 8%, 175 per bison, right? 92% into 175, right? That minus 600 bisons into $1. What's the answer? That's the answer. Tell me the answer. 175 92% into 600 minus 600. The answer is B. 96,000. Okay. 96,000 is the answer. Clear? All right. Please make sure don't let go of these little standards. These little standards can get you free marks, no? Was that difficult? No. Just knowing IAS 41 would help you get that 2 marks. Okay. Right. The next question says, on 1st of February 2007, Kahama co-invested in the ordinary shares of Bagamoyo Co. Okay, this is IFRS 9, investment in equity or debt instrument. Investment in equity instrument. So what are going to be the transaction? I mean, how are you going to measure it? Amortized cost? Will you use amortized cost here? Only investment in debt instruments, you use amortized cost. Here, it's either fair value other comprehensive income or fair value through P&L. FVOCI, if there's an irrevocable choice that's made in the beginning, right? And you are intending to hold it to maturity, right? Right. On 1st of February 2007, Kahama Co. invested, right? Paying 7.2 million for shares and an additional 0.8 million in brokers' fees. FVOCI, do you capitalize the broker's fee or do you not? Capitalize or not? Capitalize. Very good. Shareholding was less than 1% of Bagamoyo Co.'s ordinary share capital. Kahama Co. made the irrevocable election to classify this investment as fair value through other comprehensive income. At the recognition date, at 31st December, the fair value of the investment was 8.4 million, and this was correctly accounted for. On 31st March, Kahama Co. sold the entire investment for a cash consideration of 8.9 million. Calculate the gain or loss on the investment to be recognized in Kahama Co.'s statement of profit or loss. Tell me. What are the adjustments when you take into consideration? 7.2, 0.8, then 8.4, 8.9, all that figures. Yeah? Yeah, Amar? Huh? 8.4 is not taken. Then what is taken? 7.2 and 0.8. It's a very straightforward question. Though they've given you extra numbers, you're only supposed to focus on 8.9 and 8.4. The disposal, the cash consideration received minus the fair value. How much is that? 8.9 minus 8.4. Fair value to other comprehensive income. They're asking you the gain or loss on investment. So that is going to be 0.5 million. This is, irrelevant for this question. Right? Irrelevant for this question. But if you had to figure out what was the gain here, then you need that. Okay? Right. Kasuluko's operating profit margin has decreased from 15% for the year ended 30th September 20x1 to 11% for the year ended 30th September 20x2. Which two of the following could explain the decrease? A. Kasuluko's provided the finance increased the rate of interest on loans payable. B. Following a review of non-current assets, Kasuluko revised the useful lives of plant and equipment downwards. C. Kasuluko successfully negotiated trade discounts for bulk buying raw materials from its existing suppliers. D. Kasuluko increased the salaries of administrative staff. following new government guidance on a living wage. What's the answer? What do you think should be the answer? Amani, what's the answer? Can't focus. Okay, so let me tell you. But whatever I'm telling you, are you understanding that? Or right now you're starting to feel dizzy and you're not understanding anything? Huh? Going above the head? Okay, no problem. Watch the recording. Watch the recording. It's available, right? Okay, so here, what are they asking is, what could be the reason for decrease in operating profit margin? OP margin reduces when your expenses increase or your income reduces, right? Cost glucose provides the finance, increase the rate of interest on loans payable. Provide the finance. Operating profit, does that require finance cost? No, right? Operating profit excludes finance, it is eliminated. Following a review of non-current assets, cost glucose revised the useful lives of plant and equipment downwards. When plant and equipment's useful lives go downwards, what happens? Depreciation reduces. Depreciation reducing, operating expense goes down. Operating expense goes down. Operating profit margin goes down. Yeah. Yeah. Very good. When the useful lives of plant and equipment goes down, what happens? Depreciation increases, not reduces, Umar. Depreciation increases. Why? The shorter the useful life, higher the depreciation. Higher the longer the useful life, lower the depreciation. So depreciation increase, meaning your expenses increase. Because the expense increases, operating profit margin comes down. If income increases, the operating profit margin goes up. If expense reduces, operating profit margin goes up. Here they are asking the reason for decrease. Because depreciation expense goes up. Why? Useful life goes down. This is correct. Cost glucose successfully negotiated trade discounts for bulk buying raw materials from its existing suppliers. Trade discounts, it's an income going up, right? When income goes up, OP margin has to go up, not decrease. So this is also eliminated. Cost glucose increased salaries of administrative staff following new government guidance. Salaries expense gone up. Operating profit goes down. Therefore, the margin goes down. This is the answer. B and D is the answer. Is that clear? Is that clear, guys? Right. Final 4 questions to go. Yeah. Final questions. Final 4 questions, and we are done. These are some of the questions, again, I'm reiterating, that students have found difficult and examiners have been very particular about this. Right. On 1st of May 2025, the directors of Hooved Co. entered a 5-year lease for equipment. The present value of future lease payments was 185,000 at 1st of May 2025, prior to the first payment. The terms of the agreement requires annual installments of 45,000 to be paid in advance. Now there's an advance payment. And these commenced on 1st of May 2025. The rate of interest implicit in the lease is 11% per annum. What is the total lease liability as of 30th April 2026? How do you do that? Again, opening liability. Now it's a payment in advance, okay? Payment. How much? 45. Interest, 11%. Or, net liability. Then interest is going to be on the net liability, right? Interest 11%. Right? How much is the liability? 185 minus 45 is 140. Into 11% is how much? 140 into 11%? 15. So what's the closing liability? 140 plus 15 is 155. So what's the answer? Nearest thousand, so the 30th April is 155. What's the year? 1st of May to 30th April. So first year's year in liability, 155. Okay. Right? Is that clear, guys? Right. Next question. Gentleco is a company which manufactures ovens and supplies them to retailers. There are no direct sales to the public. Which to the following would indicate that Gentle Co. should recognize revenue at the point of delivery? Now, these are all theoretical understanding of standards. Sometimes we focus so much on calculations that we forego the theoretical understanding. And what happens? We end up being confused and end up, getting boggled in exams, right? Right. A, the retailer must pay a penalty to Gentle Co. if it returns new ovens which are in full working order. B, the retailer has signed proof of delivery and unconditionally accept the delivery of the ovens from Gentle Co. Now, B is clear cut, no? B is clear cut that at delivery, there's a proof of delivery. So at that point, you can recognize revenue. That's clear cut, yeah? Gentle Co. has statutory right to request the return of the ovens in exchange for the original consideration without further compensating the retailer. Now, this goes as sale and lease back arrangement, but it does not meet the criteria. Therefore, it goes as finance arrangement. Obsolete models of ovens may be returned by the retailer to, now here there is something called call and put options, right? So Gentle Co. has a statutory right, meaning Gentle Co. can call it back. And obsolete models of ovens may be returned by the retailer, meaning retailer can put it. Right, again, this is a part of this and finance arrangements. So both of these are eliminated. Retailer must pay a penalty of Gentle Co. if it returns new ovens which are in full working order. Now, what does that make? That makes Gentle Co. to receive compensation, right? Meaning the sale will need to be recognized at that point. Right. Right. Next question. Swimico purchased 60% of the 32,000 ordinary shares of London Co. on 1st of May 2026. The consideration included a share exchange of 2 shares in Swimico for every 5 shares acquired in London. The fair value of a Swimico share at the date of acquisition is $15. Also included in the consideration is the cash payment of $157,500, which is to be paid on 1st of May 2027. Swimico has a cost of capital of 5%. Calculate the fair value of consideration to acquire London Co. 32,000 into 60% into what's the share exchange? 245 into 15. Tell me what's the answer? What's the answer? Calculate and tell me what's the answer. Hmm? 115, 200. Then they are saying consideration a cash payment, a deferred consideration on 1st of May, right? Deferred consideration. So how much is that? 157,500 into what's the cost of capital? 5%, 1.05 to the power 1. What's the answer? What's the present value? 1,500 into 1.05 to the power 1. Yes, Azmat, you got it right. Very good. That's why I asked you to read the examiner reports. All these questions are from examiner reports. Okay. Now you'll understand why I reiterate to read the examiner reports. Okay. I knew that you all would not have read it. That's why I myself prepared to call the questions from past, from March, June 2022 to 2024, all the exam reports available and put it in a file. 265, 200 is the answer. A. So please feel free to read the examiner reports because section B questions are there, which I have not brought in. Okay, that's why I want to reiterate at the end. I'll keep that for the end anyway. Procurco held 270 units of work in progress within inventories at 31st May 2023. To date, work in progress has cost a total of 21,600. It is estimated that cost to complete are 19 per unit and that the finished goods would sell for 114 per unit. Direct selling costs are estimated at 5 per unit. Right. IAS2, lower of cost and NRV. This is for finished goods, right? Work in progress, lower of cost and NRV. What will NRV now here? What's the NRV? Selling price minus cost to sell. Here NRV is going to be selling price minus cost to complete minus cost to sell. That's the difference between finished goods and work in progress. Okay, that's what made the students go haywire with this question. Okay. So what's the cost to complete? 19. What's the cost to sell? 5. What's the selling price? 114. So NRV is 114 minus 19 minus 5. How much is that? 114 minus 19 minus 5. How much is that? How much is that, guys? Quickly calculate and tell me. 90. Right. 21,600. How many units? 270 units. Tell me cost per unit. 21,600 divided by 270. What's the cost per unit? What's the cost per unit? What's the cost per unit? 80. What's lower? NRV or cost? Cost is lower, right? So you have to take this figure as it is. Okay. Lower of cost and NRV. This is lower, so you take this into number of units. Clear, guys? Is that clear? Okay, at this point, I am not sure how far you'll be able to do all those Azmat. So at this point, what I would reiterate to you all over and over and over again is read examiner reports, please. We did section A of examiner reports from March, June 2022 to March, June 2024, but we did not do section B. Section B examiner report has some questions, one scenario, 5 questions each. So that would open your eyes to. Now, these questions were eye-opening, right? Different perspective, found it difficult, found it challenging, found it surprising. But if you all go to the exam, you all won't find it surprising anymore. Right? So please make sure you all read the examiner reports, read as many examiner reports as possible. But please make sure from the time the syllabus was changed, let me tell you what are the exam reports that you'll have to read must. September, December 2020, September, December 2020 to March, June 2024. Read all the examiner reports, compulsory. September, December 2020 to March, June 2024. Read the examiner reports. We have not done section A for 2020, 2021. We've done section A questions for 2021, 2022, sorry, 2022, 2023, right, and 2024. Section A of 2020, 2021 needs to be read and understood, and section B questions of all the examiner reports. Read and understand. Even these questions, read the examiner reports, you'll understand where did candidates go wrong, how did they go wrong, and you would know to be in control. Okay, so examiner reports, very, very important at this point. Critically evaluate examiner reports, please. And that is what I would like to reiterate over and over again. So next, on 1st of December is most probably we are going to have our final session, which is going to be an exclusive pre-mock discussion only and exam tips and techniques. Do you all want any more sessions? Section B, right, that we could not touch upon, but let's see if time permits. I'll try to incorporate in the next final class. But whatever we've done so far should be good enough for you to be an eye-opener and go and revise the areas that you feel less confident about. All right, guys, feeling better today after 3 questions and 20 section A questions? It was a heavy day. So please make sure you all watch the, the recording. It's on YouTube, right? Please watch it again if you all want clarity, right? So please feel free to ask questions at any point that you all want. You can reach out to me. I'm very active these days. I'm being responsive to you all. Any questions you all feel stuck at, any areas you all feel stuck at, please feel free to reach out to me. I will be there to help you all out. Wishing you all the very best with your pre-mock. Please do it in the early next week. Then we'll discuss on next Sunday. But you all will have, what you all do is when you all do the pre-mock, mark it, look at the areas that you are weak, you all are strong at, and try to revise the areas that you feel you all are weak in. All right. So guys, I'll see you all on next Sunday. Until then, stay safe.
Excuse me.
Have a great weekend. Yes, Azmat?
So is there a way to like the examiner, someone marks the pre-mock paper or something?
No, there is nothing as such. So you mark your own paper, you will be given the answer sheet, then we will discuss.
Yeah, I
Maybe
was
now.
told by someone that there's a way that they mark it or something.
The examiners.
I'm not sure whether it's the examiners, maybe it's someone else, but I was told about it.
Okay, just attempt and let me know.
Yeah.
Right?
Okay, sir.
All
Can
right,
I
guys.
send you section C to mark?
Sorry?
The section C to mark.
Yeah.
Can I send
Yeah,
you that? Yeah.
You can pre-mocks, you attempt it, share it with me. I'll mark it for you all and share section C. Right? Even section A also, if you all want, you all can share it across with me. I can help you out with that. Section C, you all can get to me. Send it across to me. So all the very best, guys. I'll see you all on next Sunday. Until then, happy preparing, prepare well, all the very best, and looking forward to seeing you on next Sunday. All the best. Have a great week ahead.
Thank you, sir.